right. Hello, everyone. All right, let me hide this. Let me get situated here as we get this live stream started. So if you guys look at the description below, there should be a timetable of all the topics we're going to be discussing today. Helps keeps us organized. Don't think we're going to keep to that super strict, but we'll see. The attempt is that we have some semblance of a schedule and that we're going to cover more or less all the topics in there. I will probably go over more topics that are not in there, especially if it's sort of like questions and answers. There's going to be a whole segment. You can see we have it scheduled up through, 2 hours. Okay. So with that being said, let's get right into it. If you guys have any questions, as always, I'm more than happy to answer them. And I will star them and we'll get to them in the Q&A section. So if you're patient, you'll have your question answered. Okay, so the first topic of today, we're right on time, 5 minutes, is New World Order, and calling a little bit of a BS on that. It's a little bit of a fun topic that, since I don't do that much public content anymore, it's kind of old news. It's about 2 weeks old. We had, Mark Carney go in front of the world at Davos and say, oh, it's a new world order. And, the United States, blah, blah, blah. So we're going to talk about that and kind of, rehash that. We're also going to be talking on the same segment, the NVDA sales to China. And we're also going to be talking briefly about the situation going on in memory. If you guys don't live under a rock, you know exactly what I'm talking about. So let's first talk about the whole New World Order narrative. Very quickly, and I tweeted about this. If you follow me on X, I X posted about this. I already shared my thoughts on it the moment it happened and the aftermath when we basically got other officials sort of backtrack the comments. If you are of the belief that the United States is sort of in decline, I disagree with you, and we can talk about that more. But that being said, the whole New World Order narrative, even by the folks at Davos, especially the ECB, were a bit sort of dismissive about it because it doesn't really align with reality. And of course, the same government of Canada doesn't really agree with it unilaterally. There is, of course, like a unquestionable amount of emotional baggage that comes with that. The rationale for saying such a thing, I think, is just performative in nature and coincides with the renegotiation of USMCA that we'll see in the summer of 2026. So right around the corner. We talked about that last year, how USMCA was always meant to be renegotiated in 2026. And we're going to see the effects of that. We're going to see more or less what happens. I'm more of an optimist about what that means for Canada. I'm not a doomer for Canada per se, but on the whole New World Order narrative, I throw it into the bucket, with the same thing about the US dollar losing its power, which we'll be talking about here. And I'm working on an actual essay or write-up on that I'll be posting on X publicly. Sort of sharing the thoughts I share with the club members. I talked a little bit about this over the past couple of weeks in particular regarding the metals. And that's going to be kind of like a more, let's call it a formal overview of our thoughts on the metals market and a lot of what's been driving that. But we'll talk about some of that in this stream. But kind of circling back to how I kind of picture the whole New World narrative and how that affects investing or stocks. I view it as sort of a nothing burger that just adds a lot of noise into the mix. So you might see, as we've been seeing, elevated levels of volatility. We saw 2 instances of the VIX spiking almost to 40, or depending on the product you're looking at, but the VIX futures are spiking close to 40. And we're seeing, I'm thinking of the triple leveraged one, by the way, or is it the double leveraged one? So apologies, not the actual VIX. Because I was actually just looking at that one with Andrew 2 days ago or something like that. But anyways, so when we're looking at volatility expansion, that is something that is driven a lot by these narrative formations that have persisted through Q3 of last year. How many live streams did we do last year just talking about the consumer is dead narrative and how that continues to be not grounded in anything real, which we're going to talk about in today's stream as well, because we had more reports from Visa, MasterCard, on and on and on, kind of saying more or less the same thing. But the New World Order, coming back to that and finishing this off, it's probably going to end up becoming yet again the nothing ever happens chud moment, where we end up seeing really nothing exciting changing. We're going to see more or less the same in terms of, where the hierarchy is of consumption around the world. That, of course, things are, that things are happening. That's not to dismiss it, but things are not happening as dramatically as some people might espouse. And there was, I refer to you back on my thoughts back in April of last year, and I'm thinking about making public the all hands on deck meeting I had with the club members. I was actually going over old discussions that we had, and I found the discussion from April 6th, the all hands on deck, where I discussed the trade fears and what we envision. And a lot of that actually aged really well in terms of kind of prescription of policy. And the New World Order, if there's anything, is more so and this connects to gold and silver when we get to it, is more of a decoupling between the United States and China to an extent, not entirely, but to an extent. And we'll talk about real quick and how that now connects and flows into NVIDIA. So NVIDIA actually reported more surge in sales demand from China for their chips. And so a lot of that has been sort of the back and forth we saw in 2025. Brief shout out to Wall Street Journal, how terrible of an organization that is for journalism. If you read the Wall Street Journal, I highly recommend that you question nearly every article that you receive from them. Last year, the amount of times they've reposted old information on United Healthcare, I can't count it. The amount of times they posted fake information on NVIDIA, on delays that were happening that weren't happening back in 2024, and I believe even in 2023. And then recently they posted a article that everyone cited, everyone was circulating. One of the members sent it to me, and then I sent them the latest information that came out, because I already know when it's Wall Street Journal, low value information or net negative value information. They posted that NVIDIA walked away from the OpenAI deal, 100 billion. Jensen comes out not even a day later and says it's going to be among the largest investments. The $100 billion figure, where did it come from? No one knows. But the Jensen's own comment says it will be one of the largest investments NVIDIA has done in a third party company. So the takeaway from the original article was a lot of people read that and said NVIDIA's walking away. They're reading the Wall Street Journal. That's the problem in the first place. But anyways, wanted to give them a brief shout out, because I always rag on the Wall Street Journal. Recall that it was very obvious last year that where Mexico was sort of positioning itself with the United States, that there was going to be, again, alignment with the United States. And then the Wall Street Journal came out and with another article, and I tweeted this one too. You can find it on X. It's so ridiculous that they were surprised that Mexico was putting tariffs on China 50%. They were surprised, and they said one of the unexpected winners of the trade war, Mexico. No one saw that. Like, apparently at the Wall Street Journal, no one can see that coming. And I believe one of the guys I follow who's just basically focused on trucking and trucking data, he was very polite. He said, not to bash you guys, but this was obvious, because it was. A lot of people were pointing out that the greatest winner of it all was, in fact, a country like Mexico, which was going to receive a lot of the nearshoring infra demand. So the Wall Street Journal didn't know that. Anyways, rant over on Wall Street Journal. Okay, only thing you might look into Wall Street Journal if it's about China. Oh, yeah. Okay, I pay for the Wall Street Journal. No, don't do that. Okay. Oh, yeah, you guys notice I'm streaming from Strongman's house. He let me borrow his house. And I don't quite have the camera set up properly on this rig. I bought a new computer, given... I'm not going to fiddle with this right now, but because I don't have my settings like I used to. So I'm going to make myself disappear. All right, a little bit better there. All right, because I have to do like little tweaks and adjustments. I don't have it as perfect as it was before. Well, it's never perfect. I'm not a camera guy. Where is Strongman? Oh, he's in the bathroom. You know, he let me take the living room, and he's just like, but of course we inverted or we rearranged everything because I think he has everything on the opposite side, and I have everything on this side. So I moved the piano over here instead of being over there. But you know, he'll show up. He'll show up behind me sometime. Anyways, okay. So on to the last bit of this segment. We're going to talk about memory. But NVIDIA, like I said, really strong demand coming out of China. And a lot of people will look at that and say, well, the decoupling narrative doesn't make a lot of sense if you have this, you know, sales going to China. Well, that's not entirely true. So I go back to a post and discussion I shared regarding elasticity and inelasticity, especially when you're analyzing, you know, any trade conflict, any trade imbalance. Because if you simply look at you know, one trading relationship with another trading relationship, and then you ignore the differences in elasticity between the product categories, then you're not going to see really who has the leg up on the other. And stuff like technology, especially, you know, things that require a lot of technicality, architecture, like semiconductor architecture, NVIDIA, AMD, et cetera, or semiconductor equipment. A lot of that is easily thrown into the bucket of inelastic. Meaning it's not very easily replaceable, and pricing isn't too much of an issue. So when we see changes in price, we don't see a lot of change in quantity demanded. It's a lot less sensitive to that. It becomes more crucial. So making an adversary dependent on something that is inelastic is actually to your benefit if you're trying to or an attempt to deter any future conflict. But if you have a lot of dependency through elastic products, then that's not as much of a deterrence as you might think. And so that's the little caveat there. So there is actually a tactical reason why the United States would be okay with NVIDIA actually selling these GPUs, and with certain restrictions, of course. It's not like, you know, willy-nilly. So that's kind of like the counterpoint, because I do see that being asked here and there on X. You know, it's like, why would this makes no sense? Well, it does make sense, again, if you take it from the framework and lens of dependency, elasticity, inelasticity, et cetera. Which, by the way, if you guys haven't been seeing or paying attention, the trade balance between the United States and China has deteriorated significantly for China in that case. What we do see is that the percent decline from imports from China was roughly 20%, with a very small decline from imports China from the United States. And again, that gets back to the inelasticity argument. So if you impose a tax, a price increase on products that are elastic, those are going to be a lot more sensitive to changes, because the end consumer is a much more let's call it impacted by that. So if you have a change in price, you have a greater change in quantity demanded on an elastic product. And through the inelastic products, you have a much smaller effect from price and quantity demanded. And so that relationship between the United States and China, if you go product by product, you kind of have to do that analysis yourself and make that determination. And for the most part, the United States has hollowed out a lot of its elastic internal product production in lieu of more specialized and technically challenging inelastic products. And so when you kind of look at the different things that it exports versus imports, you start to actually see that sensitivity is different. It's varied. And so that's not either here or there. I spent a lot of time last year talking about that, but wanted to bring that back and sort of connect the dots, so to speak. And everything connects with itself and is relevant in that way. So then what's going on with memory? So if you guys haven't been living under a rock, you might have seen that memory prices have gone through the roof. We are seeing unprecedented demand for NAND, DRAM, HMB. And what we're seeing from all that stems from the investment in data center capex. So AI, unlike any other technology from before, much like a lot of technologies from before, but unlike in terms of unprecedented amounts, requires an immense amount of both energy and memory. And in the case of memory, we have not built out the infrastructure for productive capacity that satisfies the demand. We're working on it as, let's say, a society, but it takes time. And some of the project estimates go out as far as 2028, and in the most optimistic scenarios, late 2027. Effectively, that's 2028. So all that to be said, it poses an important question that we should be asking. It's like, what are the knock-on effects of the memory shortage on everything? Well, if you're invested in consumer technology, I would be very worried. In fact, some of our members, to my knowledge, are short consumer technology. For disclosure, we are not currently. Actually, if Andrew is in chat, I would love for him to clarify because he's the guy in charge of the shorts. But last I checked, we are not short any consumer tech, but it's something that makes sense and something I know that some of our club members are definitely short. As a general idea that they're going to have a lot of pricing pressure. Now, depending on what consumer tech we're talking about, they're going to have different effects because some have more bargaining power than others. So I'll give you an example. Apple, a company like Apple may have more bargaining power than a smaller micro brand that's producing Android phones or up and coming brand. And then something like Samsung, of course, has its own memory division, and that kind of changes the dynamics a little bit. So it really does depend. And I definitely wouldn't short Samsung in that scenario because they are still benefiting from the tailwinds on memory. But we have a few sort of memory companies that, and I believe last I checked, the number one or among, I'll say it this to be more precise or more accurate because maybe there's one that's better than this one, but among the best performing stocks this year is SanDisk, ticker SNDK. And in fact, let's probably, let me go ahead and bring that up. I'll bring up their chart so you guys can see how crazy it's been. So SanDisk, an American company that has an agreement with a Japanese company for a JV to help or to produce memory. And to illustrate how insane the performance has been, they are up over 100% year to date. So now, is this sustainable? Well, if you looked at the earnings growth, if the earnings growth does not deviate from where it's currently headed, absolutely. They could produce anywhere from about $80 per share in earnings this year. If you are thinking that memory does not correct by 2028 in a meaningful way, then there's, and actually I should also caveat that, and you think CapEx spend is not going to deteriorate meaningfully until then there's only one direction a lot of these prices can go. And therefore, there's a lot of over earning still to be had for all of them, not just SanDisk, but for Micron, for SK Hynix, for Samsung, for Coxia, which is the company in Japan they have an agreement with and a joint venture. And so there's also this concern I read, but let me play devil's advocate. Hey, there's a Chinese company that produces competing NAND products, and they're going to have productive capacity online in a meaningful way. But by the way, that's figures more so 2027. That's the more optimistic one because they're moving at lightning speed. Okay, so that perchance might be a problem. Well, here's the thing. So from the Western perspective, I doubt from everything that's going on, a lot of these Western companies, Western hyperscalers are going to be too keen on utilizing Chinese supply. That's one sort of barrier to it. And I think a lot of people who kind of countered the points illustrated you might see on X saying that bearish thesis have kind of said, hey, well, hold on. There's a lot of nuance there. And let's think about this because, and I'll give you an example of a real world event. Apple thought about, entertained the idea of using the Chinese NAND on Chinese phones. So iPhones built for the Chinese consumer. And then the American administration said, no, we do not allow you, we do not want you to do that. And then Apple scrapped the idea. And so that kind of coincides or reinforces this idea that Western companies may be more hesitant to utilize anything outside of, let's say Western ally supply chains, given especially the prior narrative we've already discussed about the growing desire to lessen dependence for, let's say, some event that may or may not occur in the future. Now, when it comes to Korean companies that are also trying to build their own cloud infrastructure, the same bias may be applied there. For Japanese companies, the same bias may apply there. Perhaps you may make the argument for any that may exist European companies that may be more open to the idea. That is possible. Okay, so then coming back to memory and its importance in the next generation for Hopper. So one thing that Andrew, we showed this to the members. Jensen did a presentation where he illustrated the new design and also the increase in the real estate for memory, and because the importance of memory is only growing, it's not decreasing. So in the next generation, which we're going to see maybe proof of concept in the not too distant future, everything's moving very rapidly. What these AI models are going to be capable of with even more compute capacity, even more compute power per unit of capacity. And that's, of course, coming with Hopper. And then we see the importance of memory in that next generation. And of course, Jensen being kind of one of the greatest CEOs in terms of really getting the ball rolling, secured a lot of that supply for memory. And if you think about it, he has one of the best positions in this, where he has a lot of pricing power, going back to that elasticity categorization of his product. His product is much more inelastic, and therefore the quantity demanded is less sensitive to pricing. Now, up to a point, because this is the one sort of actual bearish take that I actually entertain a lot. And that's if input prices go up too much, it may in fact make it so that it's not worth it anymore. There is a limit to where input prices can go and where the end consumer or the end spender in CapEx is going to be willing to take this. And that could actually be one of the things. Let's see how, this kind of sort of fun prediction ends. But that's one of the sort of gray rhino issues I see for AI data center CapEx, is if input prices go up to a certain point, then you get into a situation where maybe some of you can think of any event in your life or any sort of technology that we currently know how to do, but the barrier in doing that is actually input cost. Either it costs too much energy for the end result, or it costs too much money for the end result, sort of almost a similar measure there. And we just don't do it, but we know how to do it. We know the theory of how to do it. So that could be end up what happens to DC CapEx for a moment until we get supply back online in a meaningful way. And that would be extremely bearish for memory, because memory at the end of the day is going to be highly cyclical. There's no doubt about that. It's more of a question of the time frame of when that excess of capacity comes online. And if we really want to increase capacity, we have to start today. And if you looked at ASML, if you looked at Lam Research, if you looked at Applied Materials, all of these companies, we are seeing unprecedented price increases in such a short period of time, because it's all tied to the belief, and correctly so, that there's going to be more CapEx for productive capacity of silicon, not less, in order to rebalance the supply to the demand. And again, we're seeing, okay, Micron has a few projects coming online in 2028. So does SK Hynix, so does Samsung. So that's seemingly a very similar time frame. I know Micron's purchasing an asset in Singapore, and that's going to bring on some short-term capacity once they repurpose it. And then we have, of course, some projects, some smaller scale projects coming online potentially in 2027, but we'll see. And that's something to keep an eye out for. And there's probably other projects I'm not aware of that they're working on that, but on a large scale, the number is 2028 for us to really see some new capacity come online. Okay. What's your views on NVDA? Is it overpriced now? So here's the thing. And I should have said this. I completely forgot, and I apologize. But for full disclosure, we are long SanDisk. We did not buy at these prices, but we're happy. We're holding right now. We're not a seller, and we're not really accumulating more right now, although it may end up being a mistake because of the, how, depending on how much the underappreciation for the demand for memory. But one of the things that sort of like, I'll try to argue both sides here. So on the bullish side, it is a question of the duration of undersupply relative to the demand. If that duration is, let's say 2028, then you're going to see an immense amount of pricing power beyond what we, even are penciling out for companies like SanDisk, SK Hynix, etc. And I should also, for full disclosure, we're also long SK Hynix. So those are the two in the memory space, and the rest that I mentioned, now that I cleared that out, we're not long any other memory company. But the two that we are long are benefiting tremendously at the present moment in time. And it is a question of figuring out when is the opportune time to exit, because almost one thing is certain: eventually, things will correct. But what does that look like? Where does demand go? Because demand presumably is going to also be increasing before the supply also increases. And so if that new demand, let's say by 2027 or 2028, what's the difference in that as well? And so that's also an unknown. And that could actually be beyond our expectations. We don't know. But for what we currently think, at least for this year, you're going to see a narrative unfold that there is this supply shortage, and these companies are able to increase prices to an unprecedented amount. We saw 100% growth in earnings in a very short period of time for SanDisk, and we might continue to do so. So as an example, we were penciling out that we wouldn't be surprised if nothing changes from today. All the information we know now today, because again, disclosure, that this could change. Our opinion could change tomorrow. Our opinion could change next week. But from what we know today, as of 1/31/2026, SanDisk could probably reach an earnings per share of roughly $80, right? That wouldn't be a surprise to us. But let's say, again, the one bearish narrative that I do ascribe to, or like I entertain, not ascribe to it like I believe it, but I entertain is definitely, okay, there is presumably a limit to the pricing increase before the CapEx spenders, they go, okay, hold on, I'm not paying that, or it's not worth it. Now the return on investment figures do not make sense. There's another instance or another sort of knock-on effect from memory, which is what happens to the price per compute. I should have had this up, but I don't have it in front of me. If I can find it very quickly on, because I posted this not too long ago. I'm not going to find it, but I'll describe it. So if you guys have a Bloomberg terminal, you can see the price, the indexing for prices for H100s. And what you should be seeing is a nice little spike since about November. So since November, we saw a very material increase in the pricing. And that was something we were discussing already as sort of a counterpoint to these narratives that, well, for one, the companies are committing accounting fraud is like the kind of far off opinions. And then the more nuanced opinion is perhaps saying that, it's miscalculating the cost or lives of data centers. And Bank of America put out a nice report actually showcasing and actually supporting the idea that they do actually have, in fact, 5-year lifespans or 6-year lifespans, because that's what they're seeing with older generations. They are, in fact, actually continuously being monetized. And what we're seeing with H100s, for example, is that this demand for compute is causing this actual increase in monetization on those older units. And hyperscalers may actually have heightened margins into 2026. And we should start to see that in the next couple quarters if that's the case. And we'll see, for example, Google, which had increasing margins in GCP, have even faster margin increase than what previously was expected. And then the same story with AWS, which we'll hear from shortly. And of course, Azure, which we're going to be discussing as well. And I think I'm already, kind of lost in time here because we're on the 30-minute mark and I should have already been on the next topic. So I'm going to go ahead and start just adjusting manually the timestamp. So there should be changing live or when you refresh this. But let's talk about the earnings recap. So we had, and I'm not going to talk about every single earnings because I don't have that kind of time, but I'm going to talk about the major ones. So we had Meta reported earnings, and Meta's is kind of boring from the sense of like it was good and expected to be good, at least from my standpoint. So Meta continues to show strong monetization, strong increase in utilization, strong, or not strong at this point because it's rather mature, but still growing users. But one of the kind of standpoints, and I'll highlight some of the things we talked about last time, was Meta had gone through more efficiency efforts. We saw the 30% decrease initiative for Reality Labs. And in that instance, that shows us, or that illustrates to us, that when you're punishing a company for growth CapEx, going back to this example, that's the kind of things you miss. So a company that is pursuing new endeavors and you're looking at it from the maintenance CapEx right? That should be your sort of like punishing figure, right? Not growth capex, because growth capex can be adjusted at will, at random. That could be, management decides to expand it, contract it. They can play with that. They can't really play around with maintenance capex. And so when you only look at, growth capex and maintenance capex and make no distinction, you miss on perhaps the true value of the business, because the maintenance capex is non-negotiable. If you decrease that, you risk actually your whole business. Can you even maintain the current sales figure? And then growth capex, okay, that should be judged upon some figures, like what return on investment are we getting on that growth capex? There's been a lot of doubt on Meta's return on investment. That's sort of been where the debate's been had. You see, like, if I recall, when it got down to here, we heard narratives yet again of like, Mark Zuckerberg's an idiot. He doesn't know what he's doing. You had people who are obviously not Mark Zuckerberg saying they could run Meta better than Mark Zuckerberg, which is kind of crazy, but people said it. And then sort of that narrative persisted. It comes and goes. I see it now and again that, Mark Zuckerberg doesn't know what he's doing. Although I, disagree with that respectfully. And my other sort of like counterpoint to that is if we attribute the improvements in the platform and monetization to the investments they've done, because how do I get that? Well, that's what they claim. In order to negate that, I have to create a tinfoil hat reason as to spontaneous improvement, right? So why does the product spontaneously improve rather than just taking the argument for what it is, that management said we invested this many dollars and we got this much improvement, then that's the measure that you should be using. Now, I get it. Like, you want to say, okay, this spend was completely wasteful, and ergo, you're also saying by that same token that any improvement is spontaneous, which is a bit strange to me, at least. Rather, it's much simpler, kind of Occam's razor. If the management put this many dollars into investment in compute, that investment in compute then was, preceded this improvement in monetization, the platform, et cetera, targeting, then if the management says that is the cause of this, I think it's safe to say that most likely will be the cause of this. In order for me to negate that, I have to just kind of make a new argument up. And I feel like, I'm not in the business of creating or fabricating entirely different stories. That tracks, and I'm fine with that. But again, these narratives sort of just like spin out on all these companies. But last year, on Amazon, there was the narrative of, retail is dead. They're done from the tariffs. And when that was fine, we moved to the cloud. And then when the cloud was fine, we moved back to the retail. So like Amazon just never won last year. Last year was just like a circle, a moving goalpost of like, what's wrong with Amazon? Because I remember even the Amazon management, we did live streams talking about this. Like, why are people saying this when Amazon management gave us the time frame for it? They told us that by the end of the year, you would see the reacceleration. And then we did the live stream right before those earnings, and we said, watch it be a surprise to the market. Like, watch it be something that just shocks everyone. And it did. And Amazon had that one day where it just spiked all the way to 250 because somehow, for some reason, the reacceleration was a surprise, even though that's what management guided for. But, I guess like insider information, right? I don't know. So yeah, like narratives form out of anywhere, and you see it all the time. And at this point, you should also dispel with the notion that market is perfectly, because efficient market hypothesis does not say that markets are efficient in the short term, because that's also something that in your university, et cetera, should be also described or explained. Because proving that there are inefficiencies does not disprove efficient market hypothesis. The only reason why you actually are able to in theory make money from any investment from mispriced assets is because efficient market hypothesis is actually more or less true. Is that over the longer term, the true value of the business does end up actually getting priced in. But in the short term, efficient market hypothesis does not say that everything is perfectly priced. That is more or less pricing in the price you see, more or less pricing in all information that is known. That includes all bullshit information. Okay, that doesn't mean all the information is correct. Okay, it includes all correct and incorrect information. but it's all known information. So that's the point of like figuring out what is incorrect information, what is an incorrect narrative, and what is a correct narrative. But anyways, we're not getting into a discussion on that. We are going to be talking about this towards the end in the software section, and we are going to be talking about firm in the next section. Microsoft. Let's talk about Microsoft. So Microsoft, and I haven't been looking over here at the questions. There's been a lot of questions. Let me quickly go through. It's just time goal, time to start. Yes, it's time. Thoughts on Micron. Micron, I think, is in our opinion, Micron is like the one we like the least. We like SK High. So this is the order we like it: SK Hynix, Samsung, and then Micron for those large scale producers in DDR5 and HBM. I'm talking to see MSTR. Oh yeah. We'll talk about this also on MicroStrategy. I'm going to star this. Okay, so I'm just scrolling through, making sure I didn't miss any questions. No. Why did I kill the consumer? I'm sorry. Okay, I caught up. And let me start your question on Constellation. You guys still Weight Watchers? Oh no, we do not hold a position in Weight Watchers, Andy. We have a small short of sold puts on Weight Watchers. But if you were confused, no, we do not. We never had any shares in Weight Watchers. It's basically on our. So now I'll explain Weight Watchers very briefly because it's not part of the topic. But Weight Watchers, there's the gentleman who his fund is actually long Weight Watchers, and it's Paul Serro. He's done a lot of pitches on it, so I just direct everyone to him if you want to know the general thesis on Weight Watchers. Our view of Weight Watchers is, again, his thesis makes a lot of sense. It's a more complicated turnaround story, and we think on how you kind of can play it is you can kind of wait and see for the actual turnaround to take place. But I would direct you to Paul Serro if you're curious. I won't talk about the. Oh, Dave is stupid cheap. In fact, this sell-off that we're seeing in fintech is wonderful, especially if you're not one, you don't need the capital now and you're looking at things from a more longer term view. This consumer fintech sell-off is phenomenal because it's on like no news, just sort of general vibes and sentiment. And, it's generally speaking, funny and also entirely lucky that it's happening, in my view. Okay, so let's first discuss the Microsoft earnings. Okay, so Microsoft fell off a cliff, kind of, and the cutting right down to it, everything about the report on paper, excellent. The thing that people didn't like was the exposure to OpenAI. Right now, this market has an adverse reaction to anything OpenAI. It is the new narrative. I think it's very much misplaced, but anything and everything tied to OpenAI went very quickly from darling to wow, that's an anchor that you have you're tied to. And if you look at Oracle, which Oracle continues to see increased interest in their swaps. And now you look at Microsoft, when turns out a good portion of their backlog, which now on paper eclipses AWS, is tied to OpenAI. My view is more constructive, I think. I think Microsoft is the best business in the world, or among the best. And that's debatable. I know some people will say this one or that one, but it's definitely top 3, top 5. Okay, I'll be less controversial and say top 10. I think everyone can agree with top 10. I don't think there's anyone that disagrees with top 10. Watch someone be like, no, it's actually like top 20. Top 100, my final offer. But anyways, for me, Microsoft is among, if not the best business in the entire world, among the most predictable business models in the entire world, most stable, most entrenched, among the best distribution for B2B. And I view them as being a very clear winner in anything AI related to B2B. I think their distribution in B2B is immense and will be what causes them to win. And everyone kind of, either if they don't know it, they will know it in the future. And disclosure, long Microsoft. So Microsoft gave basically what I view as an interesting opportunity of a company that has in the past 5 or so years traded pretty richly, that I now think trades at a much more reasonable price at a peg of under or under 1. And with that being said, if you look at Azure excluding OpenAI, we got close to 30% growth, again, excluding AI. And across the board, across most products that are important or pertinent to Microsoft, they're still doing a great job. They're still actually growing incrementally where I want to see them growing. I am more, let's say, favorable right now, and this is something that I'll shout out to Nash, right? And he pointed out this correctly a while ago now, that there's going to be like this switcheroo when it comes to Microsoft and the likes of Amazon. Amazon being in the doghouse, and now it's potentially going to be seen as like the cloud darling, because AWS being the largest cloud, sort of now seeing as this reacceleration bears fruit. They might end up being, viewed that way. And then Azure might end up being as it is right now. So now this could be maybe the bottoming out period, or maybe has further to go, where it's now questioned. Whoa, Azure, they're tied to this like crappy AI company. We hate OpenAI now, which has 900 million weekly active users and still not declining, right? It's not like they're losing those 900 million weekly active users. And as far as frontier models goes, they're very, very, very competitive. I don't care what anyone says. And most people cannot tell them apart, mostly when they say like, oh, this one's the best, this one's the best, and they can't even tell them apart. And really it comes down to who has now the stickiest audience. And the only one measuring, by the way, weekly is OpenAI. Everyone else is measuring non-weekly numbers because their numbers on weekly do not look good. Fun fact. A business will attempt to market itself the best way possible. Hence, when you see a company show you monthly, daily, weekly, there is the standard. The standard is monthly. And that makes sense for a lot of products, by the way, not to bash it. But if you're going to, let's say, talk about a product that is more like an assistant, more like a daily interaction, then it's actually much better to show you the shorter duration measure rather than a longer duration measure. And I question if you're, utilizing a monthly versus a weekly. And to my knowledge, OpenAI is the only one that publishes the weekly active users fairly regularly. And so having 900 million weekly active users, I don't care what you say, is extremely impressive. And if they sustain that, I don't really have that much doubt on there is value in that ecosystem. Now, what we will see, and this is what I said last year, the 2026 is the year we see if OpenAI is able to monetize. If they are able to monetize, and we're going to see their efforts hopefully bear fruit soon for them, then I think that whole narrative around OpenAI being dog shit will change, and that will change the sentiment. You'll see a rapid sentiment shift for the likes of Microsoft or even Oracle, and that would be a catalyst. And that's also going to be a broader catalyst for AI CapEx. If you end up seeing OpenAI bear proof of concept for monetization, then this cycle of investment will last longer. If you do not see them make that investment, or do not see them, make that monetization push, or they fail, then very likely we start to see or witness the potential collapse in narrative around data center CapEx. And that would be bad for a lot of these names. Potentially not that bad for companies that don't monetize compute, but it could be pretty bad for companies that do monetize compute and all of the suppliers that go into that. That would be like NVDA, et cetera. Okay, I'm getting questions. Okay, starring every question, I'm starring them. Can you talk more about the sell-offs and financials? All right, let me see. I think I have a section for that. Okay, we're going to talk about the earnings ahead. real quick, but let me focus on finishing up these, because you see, I told you I'm not going to follow the times exactly, but I'm also not going to skip over things. But let me see. Did I have a section on the financials? I think I did. Software companies, silver correction. I guess we'll talk about it in, I'll change this, financials. So we'll talk about it in the housing, mortgages, financials, crash. So we'll go over both of them, because I actually I should give myself more than 10 minutes for that section. All right, going into Visa. So Visa, MasterCard, I'm going to talk about them as one. One of the things that, and this is going to be part of one of my write-ups that I'm posting on X. If you actually listen to Visa, MasterCard, their commentary on the consumer, you find that they say, especially when it comes to North America, very robust, very resistant, very strong. And I'm going to actually, let me get my actual writing here on this. So let's see here. Visa, MasterCard reported. Okay, so no sign of deterioration. So 7% year-over-year growth, calling for U.S. consumer spending solid, no signs of deterioration, including among lower spend cohorts. Because remember, when you say the consumer's strong and you show them these other things, the next thing they bring up is K-shaped economy. And so, that's something I'm looking out for in all the earnings reports. It's like, okay, is this necessarily true? Is this narrative driven? And then again, Visa saying, among lower spend cohorts, MasterCard described U.S. consumer spending as healthy, remarkably stable, noting transaction data does not show the weakness implied by sentiment surveys. And recall that the sentiment surveys tend to be pretty bad, right? So in both senses of the word. So bad in how much information they're giving you on the real health of the consumer, and also bad in the sense that they look awful. It's actually consumer sentiment got to as low as what we saw in great financial crisis at the bottom of it, by the way. And so if you had invested last time the consumer sentiment was this bad, you actually did pretty good. But that's neither here or there. So both Visa, MasterCard, along with JP Morgan, along with Synchrony Financial, the list goes on and on and on and on and on and on of companies that engage with consumers and do see, the ins and outs, what goes in, what goes out, their balance sheets. They do not see this consumer Armageddon that people have been praying for or expecting for a long time. And I think that comes down to, especially when you see like international coverage of this, it's almost like they have the like the what's it called? They're almost like cheering on that the top dog is suffering a little bit, but it's not happening. I forget the word for it. There is a word for it. It's Schadenfreude, I believe, is the word that is more applicable to that. Yeah, it's somewhat applicable. It's somewhat applicable because it's more like you're not cheering for the best team just because they're the best team. Yes, yeah, consumer is robust. Who would have thought? No, exactly. So, and it's kind of funny because like Visa, MasterCard, okay, they're in the gutter, but a lot of that came from, and this kind of connects with good segue. So let me see what the time is, 52. So let me go ahead and change that. That will be a good segue into the next section. Well, it's not a segue because I have something in between them, but we're going to talk about the earnings ahead, which I won't spend too much time on, so that we get into the housing, mortgage, crash, financials, and all that, and what's going on with those stocks. But in the earnings ahead for this week, we have a lot. We have AFRM that's going to, again, tell us more about the health of the consumer, how BNPL is further penetrating the U.S. consumer wallet, how that's shifting a lot more spend over to them. Relative to credit cards, because that's something that spending some time on that, and again, you're listening to someone who was very skeptical of AFRM and BNPL, and then when I got educated a lot more on what it was as a product and also the cohorts that they're going after, my mind changed. My mind changed when the facts change. And so some of the things that, I learned maybe a little bit how to best communicate this. So BNPL as a product category, and we've explained this in the past, but just I'm going to pretend like this is your first time hearing this. It's not it's more of a challenge to existing credit cards. And if you look at countries where credit cards were never really heavily penetrated, BNPL is actually fulfilling that gap that they just never had. And as a product, it's superior to credit cards, especially for the lender. So I get it from the American perspective, and all the the Europeans are going to hear this and say like, yes, that's true. But credit card rewards for Americans, that's very American to have these crazy credit card rewards. And don't get me wrong, we are paying for it. We are paying for it, just like we don't notice it, but we are paying for those credit card rewards. But that's the perception. Like, I have my credit card, my wallet, and I have all these, nice credit cards, annual fees. They have all these benefits, these perks. And so for us, it's like less of a void that it filled. But for a lot of these other countries where the credit card reward system was never very good, the debit card is actually still extremely dominant. And so, for example, in many parts of Europe, the debit card is the most dominant form of card transaction, not the credit card. So BNPL is the extension of credit, but it's a lot more dynamic. So a credit card, when issued to me, they cannot simply change their mind on the loan, because that's what it is. It's a loan on my spend. So if I want to go and spend, my $18,000 car limit on whatever, they can't say like no, or let's say it's a $30,000 limit, and they're like, oh, we know you're going through some times right now, so we're going to lower that, just all of a sudden to adjust for the risk all the way down to 5,000. That can't happen. But a BNPL product is very dynamic. So from one moment to the next, every transaction is underwritten. And so for a lender, this dynamic relationship is very powerful. Versus a credit card, it's not dynamic. And then there's some key facts that may surprise you. So in the United States, I'm only speaking for the United States, that we have these different consumer cohorts. We have what's called super prime, prime, and then subprime. And in the super prime category, this is I think from the Consumer Credit Report, they release ever so often. It shows, and this is something also that one of our partners, he's the fintech specialist, and he did a whole discussion on this in the club and everything. But the super prime cohort, the 20% are using a balance or sustaining a balance. And that might shock a lot of people, because the super prime is the people that are the folks that are, they can definitely pay it off, but 20% are carrying a balance. And you're just like, why would you do that? All right. And I get it, because what we've actually filtered out for in this audience is folks that are investors, right? So that tends to be people who are, among the most money savvy, or at least I hope you are. You should fix that first before you invest. But anyway, so the BNPL product for those customers is actually a huge fix. In fact, especially if you are trying to min max, it ends up being the same, because if you think of time value of money, and you also think about a BNPL product category, you could also min max this, and for example, put it in treasuries, and there you go. You have your rewards all of a sudden. So if you have like some sort of no interest, farther out, loan product, then there you go. One other thing about AFRM that is distinctive is like the ticket size. So not every BNPL is created equal. So we do have subprime focused BNPLs like Sezzle. And so just like in the credit, because that's what I want you to compare it to. It's very similar to the credit card product. It's just superior in many ways. But Sezzle, just like how I know there are credit cards that focus, their primary focus is the subprime borrower, Sezzle is that in BNPL. And one of the key aspects, similar to the subprime credit card cohort, when you look at, let's say, I think that's Credit One. They have everything similar to Capital One, but they're not the same. But they try to almost look the same in the logo and everything. But Credit One credit cards are they're not targeting people who are listening right now. They have high annual fees. They don't come with a lot of rewards. They come with typically low balances, and generally speaking, are not very attractive credit cards. But who do they serve? They serve the guy who maybe defaulted a lot of times, has bad credit, etc. And they're going after them. That's their target audience. Sezzle, in that same vein, is targeting the people who maybe a firm rejects. A firm says, no, I'm not going to lend to you. And maybe smaller ticket sizes on average, which we do see. But a firm, what makes them a little bit special versus the rest is that their underwriting standard, you see this in a variety of ways, both in their delinquency rates, and you see it also in their ticket sizes, because growing the ticket size is actually a feat of itself difficult. It's more difficult to do that than it is to just underwrite small ticket sizes. And the actual pay in four product is the simplest product, and something that, you know, I don't appreciate in the same sense, because I mean, as a non-expert in fintechs, right? Because one of our partners, he is the expert in fintech, so his appreciation for it is, it's borrowed. I'm borrowing it from him, like I would for the semiconductor engineers when I talk to them and they tell me or explain to me how impressed they are by, you know, Amazon's team and their development for the full stack. And I don't appreciate it the same way. I have borrowed appreciation because I don't understand it as much as they do. And so it's that kind of similar ordeal there. So it's that level of excitement I see when he talks about that, where it's basically like the indication that is what makes a firm a cut above the rest. It's not just something that we should just scoff over and say, oh, you know, that's expected. No, that actually is an indication they have something going on that is better than their competitors. Then Klarna, you know, as the second player, they have a lot of distribution, which a firm is going to gain as well, but their distribution is their strength. So they're everywhere. And in Europe in particular, they have a huge distribution rate. And you see the utilization rates of Klarna. The customers are returning again and again and again. And Klarna has one advantage, which is their cost of capital is lower. But all that to be said, a firm will report this week. What I expect from them is to continue to see robust growth, taking market share from credit cards, watching out for delinquency rates, but also listening to, you know, what they're going to be solving for distribution, and the recent agreement that they had with Fidelity and Fiserv, which potentially puts them on track for underwriting as a service, which is the ultra bull case scenario. But I'll be looking out for all those things. Okay. Okay, no, this is a great question, and it pertains to this. So, sorry, mate, I was already mentioned. Was the advantage of consumers using PYPL when credit cards offer rewards? Oh, yeah, I did mention this already. So it's difficult for certain countries who have very robust credit card reward systems to understand, but you see it very apparent in those other countries where credit card never took over, because the credit card worked for the time it was introduced. And again, who's it really good for is definitely the lenders. It's a superior product in every way. For the user, that's only a matter of scale. I guarantee you, again, because of discussions I've had, that the industry, I'm convinced, the industry will move in that direction as well. You will begin to see sort of the same rewards system. It's just you're in its infancy right now. Credit cards has had a lot of time to develop into this, and BNPL in the same vein will develop into that as well. It's just a matter of time of like how long it takes for it to eventually encompass enough of the market that scale. Because who pays for the rewards is, you know, the people who are paying interest and the like. And remember that the interest per se is a reflection of risk. Credit card interest rates have gone up over time, in line with the risk profile change, because there was a change in law, I believe it was 2008, where now you can't change the interest rate on someone. And so that puts an immediate bias to higher interest rates, to raise interest rates, because if I can't increase it later, might as well stick you with the higher interest rate from now on. So the exception, of course, is promotional rates. So of course, you notice that you get a new credit card, you get 18 months, no interest. That's fine that they increase the interest rate afterwards, but you'll see like the interest rates, you know, insane. And so some people point out like, oh yeah, credit card interest rates have gone up over time. Well, the reasoning for that is, of course, you know, there's always an explanation for most things. Like that's what I love about, you know, when we investigate things. It's like for most things that we see, there's something that explains it, and we have to try to find it. And so, for example, that is the clearest explanation of like why we saw this change in interest rates across time. It's like, well, you introduce a law says they can't change the interest rate. You remove the dynamicness of a credit card at all. And then now suddenly, you know, of course, if I'm going to give you credit and it's a non-recourse debt, I'm going to stick you with the highest that I think I should to adjust for the risk. And then if you're the type of consumer that never carries a balance, you don't care, right? But anyways, coming back to that, like BNPL is again superior in every way from the underwriting standpoint, just because it's very dynamic. And in countries where you did not see this dominance in credit cards, and you still see a dependency on things like debit, this is the better way of introducing credit to that system. It is much more pinpoint. And so if you are really good at underwriting, you can pinpoint each individual borrower. And the idea is you are analyzing every transaction, every instance of spend you are underwriting. And so they bought this product, but now they're going to go buy this product. And then you analyze the risk of that purchase and you say, the risks have changed. So I'm maybe not going to extend to you the credit. But a credit card, well, I bought this product. Oh, now I'm going to go buy this product. And now I'm going to go buy this product and that product and that product. And so, yeah, just over time, we're going to see more and more. And my belief, based off AFRM's agreement with Fidelity and Fiserv, we're going to see this product categorization expand dramatically among traditional banks. And that's going to be exciting. That is going to be exciting. And we're talking about a global phenomenon, not just the US phenomenon. And credit cards were great for the time when we didn't have the technology to institute this level of detailed underwriting. But that's that's now changed. For the United States, it's a transition from an existing system to a new system. And that doesn't kill Visa, by the way. That doesn't destroy MasterCard. Narratives might hurt it on that note, but it's not the death nail. And of course, it's very slower process in the United States. It's not like an immediate thing. Okay. So, but that's the general overview of BNPL, because that's something like I felt helps a lot with understanding this, because I was there in your shoes. If you're like, the hell is this thing? Like, BNPL, credit cards. It's like, hopefully that helped out a lot. And yeah. Okay. I have too many questions to ask here. Fully understand videos, objectively better for lenders. What's good video source to understand the full picture? I hope that I'm going to do more content. So I don't know of someone who's explained it this way. I hope to do more content in the near term. That was going to be an update that I did at the very end, because I'm getting that appetite again. But physical philosophy, it's so over. All right. So AFRM, we still have a lot to go over, but I'm going to have a 3-hour stream at this point, but it's fine. I have fun. Okay, so the next one we have to look forward to is Amazon. So what are the things I'm looking out for Amazon? I think Amazon reports on the same day as AFRM, so it's a big day for me. But Amazon, what I expect to see from them is continued strength in advertising. And in fact, I see their new deal with OpenAI as being very interesting from an advertising perspective. A lot of people, right, maybe not connecting the dots here, but remember that AI monetization or OpenAI monetization is set to happen this year. What are the ways they're going to monetize? Artificial intelligence, ads, advertisements. Depending on the tier structure, I think it's going to be different. I have no idea how it's going to be. I don't work at OpenAI. And it's not a problem for me to solve. I don't work there. But Amazon is a growing ads powerhouse. In fact, one of the things I stated as a prediction was, and we're nearing on that, but soon to be, Amazon would surpass the advertising revenue, and we're ahead of schedule, I think, of Meta back in 2022. Not current Meta, because Meta has been growing. So Meta, at the time I made that comment, 2022, Amazon will surpass that and have basically the Meta of 2022, right, in terms of revenue, built inside of this behemoth company, which we're going to see that. But Amazon, as its new directive to get into advertisement, I see that's where they're going with OpenAI. I would not be surprised if the investment and subsequent partnership with OpenAI is going to be for that, alongside also Amazon moving in the direction of generally being a marketplace through cloud of a variety of LLMs, not just a single LLM. So that's something that I'm interested in sort of seeing flesh out further with Amazon. And then the other thing I'm, of course, looking for with Amazon is AWS. What's happening with AWS? Is the acceleration continuing? Is it somehow deaccelerating? Is that something we have to be worried about? And then the last bit, retail. Well, retail coincides with ads because the more retail, the more ads. But I expect to see continued strength in retail. I expect to see from what we saw in the pre-holiday spend, I think the holiday spend was a bit stronger than expected. I think that from various other sources who may have third party, let's say, input on how Amazon's been doing, I think Amazon has been doing really well, and we'll see what happens. But I think most eyes are going to be paying attention to AWS. Because that's been the driving narrative. Well, actually, I say that, and like I just said earlier, the narratives with Amazon last year just kind of circled in a loop, and it's like, oh, this is bad. But then when it wasn't bad, oh, no, this is bad. And then when that wasn't bad, they went back to the other one. So we'll just have to see. Overall, I think Amazon's a wonderful business, incredible moat, very difficult to really compete against in anything that they do. And I'm disclosure long Amazon. Okay, and then the other company we have next week that I'm looking forward to is Apollo. So Apollo is my favorite private equity player for a variety of reasons, but in particular, they've been pretty strong in the last week while the rest of private equity has been floundering. All of them have sold off a decent bit recently, a little correction, a little blip in the grand scheme of things. But this little correction for Apollo, while KKR has also done the same, Blackstone's done the same. Blackstone so far is the only one that's reported. And what I saw with Blackstone's report was more or less expectations of the same, right? I didn't really see anything wrong with the report. The market didn't like it too much or wasn't enthused. It's not like it hated it. But with Blackstone, it's a valuation question for myself. Blackstone is a tier one operator in private equity, or a tier one firm, along with Apollo, KKR, and Ares. And amongst them, right, Apollo is the most focused on private credit. They take a different approach to insurance. Blackstone is much more third-party insurance products or third-party insurance management. They have partners, such as FG Annuities and many others. And Apollo takes it upon themselves to manage their own assets through their own insurance company, Athene. And then you have KKR that's also pushing in that same vein with Atlas. So with Apollo though, what I kind of see or envision with them is like we want to see continued strength in fundraising. We saw that with Blackstone, and continued strength in deployment of capital. That's also important. Now, Apollo among the private equity firms has historically been the most efficient at deployment of capital because their underwriting their underwriting pipeline is so robust. So they're able to actually find deals very easily. And among them, they also tend to be among the best underwriters of said credit as well. But they're in terms of shops, their largest shop is definitely their credit shop. And then they also have increased their real estate portion with the acquisition that they did last year. But they still also have a decent buyout business as well. So looking at Apollo, just more or less more of the same. Don't really expect anything crazy out of them, but I'm paying attention for the usual. And then the last one I wanted to talk about that I believe, correct me if I'm wrong, but I believe it is this week, is PayPal. So PayPal, my God, just absolutely destroyed. So this is a company that the one thing I hated that they did is this dividend. This dividend makes no sense. Some of the shareholders really made the argument or case for them paying a dividend. I view the dividend as a complete waste if you think the business is trading at a cheap valuation. Now, one of the things, for full disclosure, we are out of PayPal. So we got out a bit ago at this point, and we are looking. It's like one of the things that again, our partner that is the specialist in fintech made a great observation prediction, basically that after the last earnings, what it proved to him is that PayPal, the management, and listening to the management speak again, mainly the CEO, this is not something that is a 1 quarter, 2 quarter fix. even after we're seeing the fix. What we're talking about is the street, for example, is paying attention to branded checkout and ignoring the other business units, while Venmo is a really bright spot and, you know, think it's like not being paid attention to. The street cares about branded checkout. Branded checkout's very weak, and it's going to take a lot of time for that to kind of go through the churn and the rails. And then Braintree fix, which is the one I care about the most, if you ask me, that one's already shown signs of strength, but it's not a strength that was immediate. So in that quarter, what I asked for in the live stream that was right before you see this bump, which was the last report, I did a live stream around here talking about what I expect from this earnings. We got it. We got the Braintree bump. We got the Braintree re-excel, the improvement that we were expecting. But again, that was very short-lived. We immediately saw it give up all the gains. And so if you were, you know, thinking of like, let's say a fast exit, we saw a lot of maybe pod shops take advantage of that liquidity and sort of sell it off into the close. But you know, going forward, it's like it gets really difficult to ignore. And I know a lot of investors, we saw a lot of capitulation from retail investors who've been in this for a very, very long time. We're talking 3 to 5 years. And like I said before on the dividend, I think that's just a complete waste of capital. If you think it's super cheap, you should be doing 100% dedicated to repurchases, because that's going to actually drive better shareholder value, and worry about a dividend later. But a lot of shareholders thought it would have been a good idea. I don't know why. And I hope management didn't listen to them, because that would be very negative view from my part on the management team if they took the input of short-termism and did such that. But something you want to always pay attention to every earnings report, because this is a thesis breaker, is if you do end up seeing deterioration in the branded checkout. If you do see that, it changes the calculus a lot for this investment. It turns it into much more something that you need to be trading at mid to low single digits, or maybe a little bit higher single digits, but still, I would say single digits is more appropriate, because now Braintree and Venmo will have to carry almost all of the weight, which is possible, by the way. And fun fact, on a market cap basis, I think PayPal and ADN are about the same. Of course, I think ADN is a better business in such that it is the part of the business of PayPal that I like, but pure. Which is ADN. And Braintree being part of PayPal, I favor that and Venmo over branded. Branded, I view it as a cash cow that we just need to not see decay in the business for this to work out. And so any little growth that they have in branded is a positive. But from the fintech space, this is still remains probably, you know, okay, it's cheap, but you're not getting a ton of growth out of it. It's growing at 12% per year. So, you know, a realistic fair value estimate is going to be somewhere around, you know, something maybe akin to equating a PEG of 1. So call it like 12 times earnings. And then your growth rate, your implied return comes from the growth in earnings. And if you're buying it, you know, sub 10, right? And you're doing just pure buybacks, then you're getting actually a decent return on each share you repurchase, so that, you know, maybe juices up that return a little bit in the future. Yeah, that's something like, it's not to be kid ourselves. Like PayPal shouldn't trade at really 20 times earnings unless you see somehow growth re-excel. But barring growth re-acceleration, and the same thing are my thoughts with some of these software names. It really actually comes down to the valuation. I said that in the last live stream in the beginning of December. We went over Adobe, went over a few of them, and we're going to revisit them now because I know a lot of them have come down a bit. Yeah, you just want to be cognizant of like what the growth rate is and adjust your valuation for that. So if PayPal's only going to grow at 12%, don't expect, you know, 25 times earnings to be like a fair value estimate for that. Because it doesn't have Visa level defensibility. That's just not the case. Okay. So I'm seeing a lot of pessimism on PayPal. What's going on here? You won't get me to capitulate. No one will capitulate. No one gets you to capitulate. Fiscal, when he buys a stock, he's in it. No one can really say they're long-term investor besides Fiscal. Updated thoughts on which one? Oh, Intel. We'll talk about Intel. Let me start that. Updated thoughts on which company? On this company? And let me see. I got to change the time frame. 1 hour and 18 minutes. Okay, so now we're going to talk about the mortgages, the mortgage companies, and what's going on with them. On Toast. Oh, I read thoughts twice. I thought for some reason that Toast was okay. On Toast. All right, we'll talk about that in this section because it is financial. So let's talk first about the mortgages, and we'll talk about financials. Financials being fintechs, not really the banks. But let's talk first about Rocket Mortgage and PFSI. So both of these, well, actually, I'll talk briefly about Rocket, and we'll spend more time on PFSI, which many of you may not have heard of this company. Disclosure: we are long both. And Rocket, we are long at lower prices. PFSI, we are actually, I'll say we're in a small loss, but Rocket is our larger position. And then PFSI is like our, in terms of like a ratio, if I had to give you one, it's like a 6-to-1 ratio. So we have 6 times more Rocket than we have PFSI. And together they make up like the tiny basket we have for mortgage originations. But Rocket is the acquirer of one of my favorite companies, which no longer is a separate company, was Mr. Cooper. So it used to be ticker COOP. A lot of CM Club members remember that name. And that was a 2024 play all the way through when Rocket announced the acquisition in Q1 of 2025. And then we, lost it. But Rocket now has the Mr. Cooper franchise, which by far is the best servicer of mortgages, hands down, the lowest cost of servicing. What that brings in terms of like what these businesses do is you have the origination arm and then you have the servicing arm. The servicing arm is the stable part of the business. For the most part, you have this dual pronged approach that when together they work as well into one unit. What I mean by that is the servicing arm is this huge portfolio of relationships that you have that you can then filter over to your origination arm. And this dynamic, this relationship allows for this sort of flywheel effect to form. Rocket has the best of everything at this point by far. Like if you told me, like, for example, the next company we're going to talk about, PFSI, Rocket is better than PFSI in basically every way. There's a small little advantages PFSI has in certain things because Rocket doesn't focus on it, but Rocket in every way has an advantage. And that is why we do favor Rocket pound for pound if the valuation was the same. But you'll see in a second, PFSI is much cheaper, but it deserves to be cheaper. So Mr. Cooper, which was my favorite company in the space, was primarily a servicer. And so the originations arm of Mr. Cooper was sort of this afterthought that you didn't really have to get it going to get a good return. It's almost like this optionality that you had if rates went down, and then you saw this servicing volume pick up. Oh, sorry, origination volume pick up. So for full context on the whole space, we are in this crazy bear market for originations. We haven't seen this low origination. Well, in 2025, we haven't seen this low level of originations in decades. And so this lack of appetite is inputted by there's a few factors going into it. One of them being not a lot of people are, desperate enough to sell their home. So you do have buyers, you have a lot of demand, and we know this because these sideline buyers back in Q1 of 2025, we saw the long end of the curve drop a little bit. And then the step change in quantity demanded for that was drastic, which means we have pent up demand. We have a lot of people that do want to buy or move or et cetera, but they are not in a rush. Then that's the other thing that kind of makes this market different from other markets. Because, for example, in 2008, you had this recession that pushed a lot of people, forced them to sell, forced these transactions to occur. You just don't have that right now. Kind of tying back to consumers' dead narrative being bogus, you're seeing that in the housing market, the housing data. We have record levels of equity. And then this lack of desperation is fueling this no movement, no volume. And which has put all of these companies, Rocket, PFSI, at least their originations business, in this sort of like quasi bear market that more than likely has only up to go, because the likelihood that we keep getting worse is relatively low. And you are seeing improvements. That's the thing. But not the improvements maybe some would expect or hope. So Rocket acquires Mr. Cooper. For what reason? Well, Mr. Cooper, like I was saying earlier, had the best, by far, servicing business in the game. They had the lowest cost of servicing on a per unit basis, which means best margins, etc. And of course, Mr. Rocket Mortgages, just like how we saw this in Mr. Cooper, saw the same thing, and then they wanted to buy it. They saw the value. And Rocket now has Mr. Cooper embedded in it. They just plug and play their servicing portfolio now onto Mr. Cooper's platform, which now boasts a size of over $2 trillion in mortgages. And then there's also, a lot of things you can do with that. There's third-party capital you can start incorporating in there. There's a lot of cool things that the servicing business can do. Not just, essentially print money, but effectively they print money. And then the originations business, Rocket was the best. So Rocket in that business already was the best. And then they just bought the best servicer. And then they bought the second best real estate platform, Redfin. But the vision of what they're doing is what I always wished Zillow would have done. And I thought Zillow had the chance of doing, but Zillow has squandered the opportunity time and time again, which made me a little bit frustrated. If you go back to my old videos of Zillow that I used to cover, I used to say that about Zillow. It's like, there's a lot of potential in Zillow. Zillow could become this whole one-stop platform and do all these different things and add-ons. And then Rocket is over here doing that when, frankly, Zillow could have been doing that. And Zillow had the best online platform, but Rocket now has the second best, but they have and they could turn it into the best. We don't know. But they do have the best origination platform. They do have the best servicing platform. They have a pretty robust B2C product as well, and they're growing in that category. So all that time spent kind of hyping up Rocket. We're about to talk about a company that's almost worse in every single way. So it's difficult, but that's the cause of Rocket falling down was PFSI, and that is PFSI. So PFSI, good company too. It's not like they're a bad company. It is a good company, but it's just in every measure, it's not as good as Rocket, but it's cheaper than Rocket. So now what happened? Well, a couple of things. The primary cause for the sell-off was a massive disappointment in return on equity. Return on equity is one of the measures that we focus on when we're looking at the return profile of these businesses. It's one of the ways. So typically, the higher, the better. So the higher it goes, the better it is. Of course, barring some potential messiness with the denominator, because that could always make things a little fluffed up. But if you don't see any, craziness in there, ROE is a really good measure of quality for these businesses. And what we were expecting from the prior guide was that, hey, we're going to expect high teens ROE. Came in at 10%. Massive disappointment, massive panic. You see the stock sell off at one point, all the way down to book value, which if you pick this up at book value, wow. But book value currently sits at about $82 per share. But generally speaking, book value, that's dirt cheap. That's like the bare minimum. And arguably, actually, in hindsight, we probably should have thought about selling our meager position in this company just because it was trading at 1.2x book value. But that's neither here or there. But now we are where we are today, where PFSI sold off quite a bit. And now the valuation actually, I think, is fair because we were in a holding pattern. It's like not add to PFSI, not really sell it. If they continue to print robust ROE, strong performance, obviously you should trade at a premium to book at that point. But now you're trading at a slight premium to book with, by the way, guided. Now you might say, oh, I don't trust management. That's another story. But guided return to mid high teens ROE by end of year. So if that actually pans out, this will be a buying opportunity. If it doesn't, then not a buying opportunity. In fact, just that point, stick with Rocket. And what you're playing with both is, again, this resurgence in origination volume. And they're going to have a lot more torque because you could play it with FICO. FICO is another great company. In fact, there's probably less risk with FICO in some fashion. It's really more of a question of valuation. But these guys are going to have more torque than FICO. What I mean by that is, like, if you do see origination volumes spike up, FICO is going to feel that in their earnings power. And I actually think FICO's valuation is a lot cheaper than people imply. I had shared my thoughts this last year on this, and why I think Pulte is a kind of a clown for saying what he said about FICO, or if he actually believes that he's a clown. If he doesn't believe it and he's doing it for, other reasons, then maybe it's like some sort of like 5D chess move that I'm not aware of with him. But for the most part, I don't agree with his thoughts on FICO. But not for the most part. I literally 0% agree with him on his thoughts on FICO. But FICO as a business is another way, just has, in my view, just less torque. But love the company nonetheless. And I went over on a rant. I don't know if you guys want me to rant on this, but like why FICO is irreplaceable, why the whole argument on the Vantage score is dumb. But I had the whole live stream. I spent maybe an hour just on that topic of conversation, because it really is ridiculous. But yeah, that's the cause of the crash, so to speak, in the housing. And it also brought down FICO. Don't kid yourself. FICO is also now down traded to like the 1,400 range, which in my view, I think is also an interesting opportunity, because, well, we'll get to it. I said I wasn't going to get to it. I'll get briefly into it. The business that FICO has, a lot of it is pricing increase. So they have tremendous pricing power. And then what people are not calculating in their models is its pricing power with another factor, volume growth. So volume returning somewhat to normal, plus that pricing power, or multiplied by that pricing power together, you're not even surprised if, when we see that, you see FICO's earnings that year grow north of 50, even 100%. And then that's what the market also somewhat understands. That's why it trades at 36 times forward. Even it was more expensive before, but I saw that sell side analysts have made their various adjustments, and I think for the most part, a lot of buy side analysts agree with that. Sell side, more or less also agree with that too. That it's if you read the reports, it's like, yeah, if there is this volume spike, then it's off to the races. It's a lot cheaper than what it appears. And then FICO's other move was genius, because when they and if you guys also didn't see that. They did a move where they're going through this like credit bureau war. This spike right here was because they basically did a whole switcheroo. You had Equifax, TransUnion, and Experian with Vantage score. For some reason, Equifax is the only one that people talk about, but the Vantage score is all three of them. They started to be a little bit more aggressive in their competitiveness, which is a lot of showmanship, if I'm being honest, because it's just keep FICO in check in some respect. But then FICO fought back, and I think this was a lot egged on by Pulte, where they offered a direct product, and this genius actually should be like very appreciated in terms of a business move, because it's a price increase, but without officially doing a price increase. So you're effectively taking the margin of the other guy, and you're keeping it for yourself. So you're offering the end customer a lower price, but for your take rate, you've increased it. So genius, right? And this direct product will actually, in my opinion, be a huge driver and on a go forward basis as it starts to circulate through the system. And that puts it into maybe a stronger positioning over the credit bureaus. Maybe that's yet to be seen. But yeah, that's all to be said. I like FICO. All right. Oh yeah, we can go into Netflix. We can update thoughts on Dave. NVIDIA not selling China. Can I ask a few questions? Of course, you can ask a few questions. I invite all questions. Okay, so let's talk about financials. So the financials, we are going to be talking about Dave in this, but all the financials sold off, mainly fintechs, as soon as the president said, I'm going to introduce a cap on interest rates of 10%. That notion threw everyone into a frenzy, even though it doesn't affect everyone equally, because in particular, it's more of a theoretical impact on credit cards, right? Because that's where it spurred up the fuss. And of course, it's an election year, so a lot of crazy things get said on years like this. Well, let me start with the obvious. So first of all, by the way, let me actually call out a company. So the Built card from, I think it's a partnership of Wells Fargo. Yeah, I'm fairly certain it's a Wells Fargo branded credit card. Well, it's a partnership, not theirs, but the Built company. They offered an introductory offer of 10%. That is so hilariously dumb. As far as like a offering for consumer, it's smart in the sense of marketing, but like it's not a good offer because I mean, raise your hand. Well, I can't see everyone, but gentlemen's trust, raise your hand, right? And spiritually, I'm noticing you. I'm seeing all you raise your hands. Raise your hand if you've been offered a credit card with 18 months, 0% interest, or 12 months, 0% interest. That is the regular offering that I would typically expect from a credit card. The fact that their introductory offer is 10% interest is awful. It's like, if I go on B of A right now, or on Chase, or on any major bank, most of their cards are offering me like 0% for like 12 to 18 months, in very few occasions, maybe even more. And then Built comes out and is like, oh yeah, 10%. Yeah, look, we have an introductory offer, 10% interest for the first 12 months. It's like, that's awful. Like, I'm not even interested. So under that notion, it's like, it's a great marketing strategy, but if you think about it for more than 5 seconds, you're just like, that's awful. But great marketing, but it's still awful. And in fact, it's just beneficial to you. You're just saying, I'm not going to offer the 12 month no interest. That, it's more or less a standard. Well, I guess it depends on your credit score, but it's not an abnormal offering for you to get 0% interest for a certain period of time. So that's what caused it. And we see that extending into a bunch of other companies. So we see that extending into companies like Dave. So let's talk about Dave for a moment. So Dave, for full disclosure, if you guys didn't know, we are Long Dave. We have a video on Dave, actually, where Andrew, the God Emperor of Dave, formal title, by the way. And I should say, well, I'll say it vaguely, but almost like on the nose. We may or may not be discussing at some point in the near future with the management team of a particular financial technology firm that is of great importance to us, or we have great admiration for in terms of the company itself. But I'll leave it up to your guesses. It will be public, so that's exciting. But yeah. So there you go. I won't confirm nor deny any company. Up to your guess. There's a huge hint that you might be seeing it right now. But yeah. Okay. So +1. Okay, great. I love the questions on Melly and Essie, and we'll get to that. But okay, so Dave. So on our forward estimates on the valuation, it's trading at roughly 7 times EV to EBITDA, and EBITDA conversion rate to free cash flow is nearly 100%. So effectively, it's 7 times free cash flow to EBITDA, and we think that's extremely cheap for a company that's growing at the rate they're growing. It's still understandably misunderstood, understandably so, because EWA as a product is not it's not the most well-known, most covered. So understandably, not very well covered stock, not very well understood stock, but that's fine. And so really it comes down to the investor understanding what it is that they're investing in, understanding the business a lot better. The business itself, in effect, is nothing short of a cash printing machine. It has similar attributes, very similar attributes to a very dynamic giver of credit, like we were talking about with buy now, pay later. So the duration of loans are ultra short. So if you thought BNPL was short duration loans, which gives it some form of advantage in terms of being dynamic, EWA is even shorter and with a lot less risk of delinquency. So because it's tied to paychecks. So it's not the traditional form of, like interest payments per se, but it's more so a fee-based interest payments. And the duration of the loan is crucial to understanding the velocity of capital moving through the system. Companies like AFRM, Dave, Pagaya, even SoFi, which we'll talk about in a second. All of them, one of the measures you want to focus on is the velocity of capital, the velocity of money moving through the system. So if I have $100 million and I put it through the machine, so to speak, and I put it through the machine many, many times, then even if my margin, let's say my net margin on it is somewhat low, that machine is going to go through it so many times that my annualized profit is going to be actually quite high. This sort of phenomenon I can explain to you with a grocery store. So let's take a grocery store like Walmart, right? So Walmart has there's some good things about it and there's some bad things about it. We're not going to be discussing the valuation. That has nothing to do with this conversation. We're going to be talking about the business model. A retailer, right? It's boring but simple. So a retailer, if you have to guess, what are the margins of Walmart? I know that you saw a TikTok that said Walmart's like, making crazy tons of profits and stuff like that. It's really moving money from A to B. The margins per se, the value proposition Walmart gives you is very high. They profit a low single-digit percentage over all the things that they offer you. So when you go to Walmart and you enjoy the low prices, they are taking a really small cut of all of that. So you're paying for in that purchase and that margin that you're giving them a reward for all of the things, the infrastructure and everything to provide you the product at that price. And so Walmart has a low margin. So then how the heck is this a good business, or how can it be a good business? Well, the second part of the question when you're analyzing a retailer is inventory turnover, which is similar to what I'm describing with the velocity of capital, the velocity of money. So when I look at a grocery store, when I look at Walmart, or when I look at any retailer, it's all about the inventory turnover rate. So even if you make 1%, but if your inventory turnover rate is double the competitors, then I would be very happy to invest in that business, even if you have a lower net margin. Because it's a completely almost different way of looking at it. You're never going to see a retailer with the margins of Visa, to be extreme. It's never going to be 50%, but it's going to be something else that kind of makes up for it. Well, how often is Walmart, turning over the inventory? They buy the inventory and they turn it over. They buy the inventory and turn it over. And how many times do they do that on an annual basis? And that's the name of the game. Well, the same thing is true for some of these, like Dave, right? And with Dave, it just so also happens to be that the margins are pretty good. So they kind of have both. It's not like retail margins, but the velocity question is also something you want to pay attention to. And you also want to look at that for AFRM, Klarna, SoFi, Pagaya, on and on and on. How many times do they turn over that capital annually? And, how much is that origination translating to then profits? Okay, so because in some of these cases, what they're doing is they're selling the product. And Dave, it's just because it's such a short duration product, they can cycle it again and again and again and again. And then on that note, Dave itself knows that they're fairly cheap, and in an early stage opportunity, right? They are buying back stock. What I meant by early stage is like they're still in their growth phase, and we're already seeing share repurchases. The share repurchases aren't crazy, and you don't want it to be. So if you're an investor in Dave, if you're an investor in any business and you have a lot of growth ahead of you, which with Dave they do, they have, for example, they have a BMPL product that should be coming online this year. And we should be hearing about it in the next earnings. And that gives us something to look forward to as far as further growth reacceleration. Not reacceleration, because it's already doing that, but even more growth. And the management team in and of itself has actually at this point proven themselves to be good executors, good planners. And the price itself, right? It doesn't really reflect what the business has done. There hasn't been any news from when the stock sort of peaked out before Trump saying what he said, and then today. All it is really just technical selling, right? A lot of people, just more sellers than buyers. And people, kind of having like these, technical levels that they want to take the stock to, because there's no catalyst. There's no catalyst until the next earnings. So if you could be just like, okay, I'll wait for, confirmation of earnings to buy, or some people are saying, I'll wait for this technical level to buy, and nothing's going to kind of move the stock really fundamentally until you get new fundamental news, new information, which until the next earnings, we do not have. One of the things that we are expecting in the next earnings is the beginning of seeing their partnership with Coastal Community Bank take form. That will unlock a lot of working capital, which then actually should lead to more repurchase opportunities. And so right now, that agreement hasn't been fully implemented, but by Q2 of this year, we will really see it in the numbers. So Q1, this upcoming earnings report, we're only going to see the beginning of it. Oh, hold up! I have a bot in the ban the bot. I don't even know what the point of that. It's like comes in and just puts emojis. Yeah, I don't even understand the purpose of who it's scamming. I don't see the vision bot person. Yes, exactly, because it's all about the recycling. Yes, you're getting it. So even though it's a small amount, it's moving so quickly. Okay. And not to put all the energy on Dave, but I was asked about Toast. I want to be respectful and talk about Toast, but similar story here. So Toast, phenomenal business. Every single restaurateur that I talk to who owns a Toast POS system, they love it. It spreads a lot through word of mouth. Now Toast, and I was asked the question about squaring the valuation. So the valuation of Toast, which right now sits at, I think it's like 30 times forward. I view it as cheaper than what it's going to grow at. I think sell side only has them growing at 20% earnings next year or this year. I don't think they're going to go 20%. I think it's not going to slow down from what it was last year to suddenly 20%. I think they're going to blow past that. I think that's kind of like a layup for them. What we are seeing for Toast is they're expanding into new markets. They are expanding their ARPU per restaurant. They definitely have an opportunity to integrate the following two products: everything AI. They can integrate into their product category and charge for it. And I already see the need for it, especially when kind of asking questions about inventory management and the like, kind of helping you as an assistant for your restaurant. And then the other component to it is the capital or the credit side. So one thing that Toast has as an advantage over other systems is that they know how much money is coming in and out. So they see your income statement when you are using a Toast terminal at your restaurant. Toast knows how much money is coming in and how much money is coming out. Well, how much you're buying inventory, what your capital needs are. Okay, so who do you think would love that information? Well, the answer, of course, is a lender, right? And you may or may not think about, incorporating some capital efficiency in your business by utilizing some credit. Because remember, debt is not always bad. And when you're kind of looking at your numbers of your business, sometimes there is a need or there is a benefit to kind of plugging in sort of like a credit agreement where you're just being a bit more capital efficient. Right. And it's always about that. It's really min-maxing, but it's not always like, oh, I need this money or because my business model is broken and I'm not making any money, so I need to borrow. And the lender just wants to lose money, I guess, and just lend me a dying company money. That's not necessarily the case. That's a bit of an oversimplified argument. So, and let me adjust this because I think the thing's acting up. There we go. Oh, no, it's not perfect. Maybe 52, 51. Yeah, no, 51's better. I'd rather this little corner over here be a little screwed than my shoulder. All right. Remember, I'm still setting up the camera stuff. All right. Thomas has a UNH. We'll star you. But yeah, on the valuation of Toast, the way I square it is like relative to growth, I think it's fine. And I think this is a buying opportunity, but sort of falling with the rest of fintech. There's nothing like new that's happened that causes the valuation to be, well, at $50 a share, you're pricing a lot of growth, but at $30 a share, I think, you're paying a fair price for this business. Fabio, I'm late. Please hold me. If you're ever late again, I'll ban Fuhat. Okay. Does Toast have a long runway for earnings growth for the next 7 years? How big is the TAM for restaurants? I think it's larger than you think, because it's not just restaurants. They're going to be expanding into other categories. No one asked me about Shift 4, but I was asked in the weekly call about Shift 4 that I had yesterday. And my only concern with Shift 4, it's just complexity. It's obviously cheap. So if I look at Shift 4, it's obviously cheap, right? On a price to earnings basis, on a price to free cash flow, it looks cheap. Everyone talks about it on X. It looks cheap. I get it. It's the complexity that gets me. So all else being equal, I prefer organic growth versus growth by acquisition, hands down. There are serial acquirers. We are going to talk about some today. Little hint. But all else being equal, I prefer organic growth over inorganic growth if I could help it. And Shift 4, a lot of the growth is inorganic. Toast is purely organic. Well, not purely, but vast majority of it is organic, because I don't want to discount the acquisitions they made over the years. But it's nothing crazy. It's nothing major. It's nothing, game changing to the point where it's like they're tacking on this whole business maybe close to their size. Relay it again, please. So it's not just restaurants, although even in restaurants, there is still more penetration for them to be had. It's also other countries, right? Other countries' restaurants. So international expansion, which is also more growth for them. And it's also other verticals where Toast wants to get much more into the hospitality space, which is a lot of the, almost like equal or natural transition. And the management team at Toast, I think, is by far the most innovative in the space. They definitely understand who the core customers are. They definitely understand how to launch products. They definitely understand all these things. And I think they've proven that. Their competition, right, is like Square. The realistic competition is Square and Four, because I don't consider Clover to be that competent. So Clover, part of Fiserv, I don't consider them a competent one. Yeah, you're not allowed to derail the conversation, Andrew. And then, of course, the other fintech in the room that's sort of gotten crushed for reasons is Affirm, right? So Affirm, reasons. We did see perhaps like maybe we'll see how this ages. The worst of it already, and we'll see what happens in this next week. Now it's going to fall 10% on Monday because that was said. But Affirm, similar thing, kind of, we get that announcement. I'm not going to let interest rates do whatever they want, blah, blah, blah. I'm going to cap it at 10%. Wow. You see, like that $80 it's down to, it hit under 60. Disclosure, by the way, long Toast and long Affirm. If I didn't say long Dave, if that wasn't obvious. But with Affirm, what do you get with this business? You get another very dynamic creditor, right, who can make adjustments on the fly, underwriting every single transaction. By far the leader in underwriting standards, by far, that's not even a question, versus Klarna, Sezzle, and the like, and whatever PayPal has and whatever Square has. But by far, that's the case. Maybe just lacking the same distribution as Klarna. Klarna has the best distribution. But with Affirm, you're getting growth in Europe, right? Right now in the UK, the launch in the UK. And you're also still seeing massive growth in the United States as well. So, yeah, fintechs as a whole, kind of hate it. The next topic that I wanted to get over, this is another interesting one. And this one, you see, like I said, we're definitely going to go for 3 hours. I only planned for 2, but we're going for 3. There's just too much to talk about. Is going to be the silver correction, sources of demand and dollar destruction narrative. Now, the Andrew's in the chat. This guy, Andrew, my partner. So he came on Thursday during the weekly call, and he pitched the short silver pitch. For full disclosure, we were short silver. Andrew, correct me if I'm wrong, but we covered our short now. And yeah, but there was reasons for all the members. You can check the video on Thursday, and the end of the video we explain, or Andrew, not me, Andrew explains the short pitch for silver. and why it was looking interesting to short. But anyways, so that's a little pat on the back. He deserves a bonus. But silver per se, right? As a product category, there's some interesting things to discuss here. And that's, what the heck happened? Like, where is this demand? Because there's a few narratives, and I'm doing a whole write-up on this because there's some narratives I want to dispel, similar or very similar and as dumb as Consumers Dead narrative, maybe dumber, on like, this is, an example or a measure of, oh yeah, the United States is losing its position. And it's hilarious that it kind of coincides or times well with, the appointment. That's why I put it in the title. But it's all like kind of like just this funny play of events. So silver as a metal, right, has for a long time sort of lagged and been in anguish from a lot of the silver stackers you find on YouTube. They always said eventually this moment would come. Eventually there would be this run. We saw the run, and it was parabolic to say the least. So silver, one thing that we also noticed, and this was actually a lot of the club members were sharing their anecdotal experiences with coin dealers and the like, and this was like the common occurrence, funny enough. And this discussion was again happening, just so happens coincidentally, the day before the silver crash. People were trying to sell silver and they couldn't, right? You would go around and there would be dealers who maybe offer you like a $10 plus spread, if that, but a lot of dealers were not willing to buy. And so a lot of the sellers or physical holders of silver, the whole point of holding a metal or anything, and you think you can monetize it at some point. And if you're not able to monetize it, if you're not able to liquidate it, that's a bad sign. That starts to create like the trapped trapped buyers. They bought it, now they're trapped, but they're now becoming willing sellers. But there's no liquidity, and then you can create like sudden a panic. But the price of silver in the monetary market was not reflecting perhaps the reality in the physical market, and which we'll also spend some time on today. If you haven't seen, there is a spread, a very interesting spread at that, in the silver market. So let me actually get this image, because this is going to be important to the conversation. Where did I put it? I know where to find it. I saved it over here. Okay. Give me 1 second as I find this image, because I think we're going to need it. Boom. Open image, new tab. All right, I have it here. All right. So what do you guys notice here? Or let me zoom in, make sure it's clearly visible. So this is a price comparison between the Shanghai spot and Western spot. And what you notice is, yes, there's always been a deviation, and there's a few explanations for this, okay? Some of them stemming from capital controls, difference in taxation, all the like. So different regulations and rules have always accounted for the standard difference or spread in silver between that you can't really capitalize on realistically. Okay, but this is drastic. Now, the recent separation is of no coincidence. Now, a few other macro commentators who I tend to respect on some things, especially, they were commenting correctly on, and these were more China-focused guys, because there's some that are more doomerous commentators that they're kind of always spilling some random crap sometimes. But some of the ones that are more focused on internal China dynamics have been discussing, at least for the good part of 2026, early 2026, we've only been 1 month. We are going to talk about SE versus Melly. Do not worry. I'll star you just in case. I just saw that. The internally, we just saw with China, they went through something that is very similar or worse than the 2008 financial crisis, right? In terms of real estate, and it's not spread evenly across the board. So in places like Beijing, you see housing prices decline, less than in the ghost towns where they built real estate in the middle of nowhere and no one lives there. Okay, that's also true. But the prior to that, and I don't know if this was a secret or you didn't know this, but kind of just sort of some context to this. In China, the primary form or mechanism of investment was real estate. And when that collapsed, that presented or opened a vacuum, because what was priorly thought of as the way to invest, because they do not trust their stock market. Americans trust their stock market more than they do. That's a fun fact. That's a whole different conversation. I have lots of videos on that talking about the whole irony of it. But U.S. citizens trust the Chinese stock market more than Chinese citizens. Fun fact. But that's neither here or there. So what a lot of folks in China sort of transitioned to, and we see that more now than before, is precious metals. And so there's two numbers that we can focus on within China. There's the official government metal count, and then there's the non-government metal count. And these are all at best estimates. And actually, I'll get to the official figure for Chinese gold for the government is 2,300 tons. A few other estimates from the OCEB, they actually put the estimate at 5,000 tons. And I have actually, so one of the reasons why you actually do see or this calculation is done, if you're curious, I have it listed here. So import versus reserve math. So analysts track Hong Kong plus Shanghai imports, domestic mine output, and known exports. Then compare the relatively small increase China reports to the IMF. The gap is large enough, but that a lot of metal must be going somewhere off balance sheet. So basically, there has been this belief for quite some time that, and we do see it because the reported increases, you'll see China have sudden jumps. And so everyone's like, oh, that's where that gold that we counted went, because we didn't know that gold was there, but we kind of knew that gold was there through other means. And so the OECD, when they put their estimates out, it's really 5,000 tons of gold. Now, I'm going to add to this more in my write-up, but just like to be a slight doomer, I'm not very doomerish, but a slight doomer. China's increase in metals purchases has accelerated recently. And again, I'm technically insinuating something by this, but it's not a guarantee that this will happen. I think the U.S. administration is moving. This is like their prime motive is to avoid this, but this was also what Russia did before, Ukraine. So between 2014 and 2020, the Russian Federation accumulated, what was it, like 1,400, 1,900? Let me see if I have the number in front. I wrote it down somewhere. 1,200 tons of gold between 2014 and 2020. So that's not their total, that's their accumulated. So that's here or there. And recently, with the trade surplus that China has, that excess surplus that they're utilizing, they used to use it to buy treasuries. They've increasingly been using it to purchase gold. And then I don't know if this is also perhaps maybe new information, but in Venezuela, there was a lot of gold. Well, the amount, I was actually trying to see if I could find this, because there is no way to know. This is like black market gold at this point. There's a lot of sanctions levied on Venezuela. And so exportation of gold is very difficult. And so on the official numbers, it's not very much, but it is impossible to actually know how much gold was extracted from Venezuela, because a lot of it is unrecorded and not reported. All we know, and all the OECD knows, is there was gold of an unknown quantity extracted from Venezuela outside of what is counted. The amount is unknown. Anecdotally, I can tell you that Venezuelans have known for a long time that China was taking a lot of gold to China. So extracting gold, extracting a bunch of other things, and taking it to China. So that's only anecdotal. There are no figures to provide on that. because we don't measure it, because it's all black market. So all that to be said is, like, even the official OECD measure technically wouldn't actually account for potentially all of it, because, like I said, the way they get to that estimate is based off of other figures that they're using to calculate that estimate. And so, and based off of historical imbalances that they've observed. So really 5,000 tons of gold is maybe like not the highest number at all, and not necessarily the lowest, but it's definitely not 2,300 tons of gold is what I'm getting at. So all this to be said is there's a prime driver of demand out there in the market. And I think by some estimates, China might have 15% of the total above surface gold right now, which is kind of crazy. But again, by some estimates, not by the official IMF figures. This, again, almost like the secondhand calculation of like the estimates and how much they have. And then silver, in this case, fulfills a different. So it's like two prongs, two different stories or narratives that I'm presenting to you. There's the government one, and then there's the what's going on with the civilian population. So then in the civilian population, and this is more so where I bring in those macro commentators who have presented the argument clearly, and it's that metals is utilized by the civilian population in droves when there's distrust in said government. So an example, if the United States had a lot of its population, completely distrust the US government, etc., logically, what we should observe is massive amounts of purchases of precious metals becoming commonplace, or anything alternative becoming commonplace. So I look to my right, look to my left, and everyone I know and their mom is buying silver. That would be the guessed observation, like what I would guess I would see. You don't see that in the United States. So long story short, the United States currency itself, it's the lack of faith in the US government, etc., that's not collapsing. That whole narrative is bogus for a variety of reasons. But that being one of them, is like, we're not even seeing that. And that goes back to the very first topic we talked about. Is there a new world order? No, that's as credible as bricks. So coming back to what we're observing in China and this deviation, it is not a surprise. And a lot of what those macro commentators are saying is that what we're seeing in some survey data from China. So the first time, well, this has been true for like the past 5 or so years, but for the first time in that observable time frame, we are seeing increased pessimism among the generations. And then we're seeing some trends. You see, now I can't travel to China because I'm saying all this. But we're seeing growing trends of people, what they call laying down, right, bowing out, etc. And that pessimism is reflected in the behavior of purchases for precious metals. And precious metals also work together, alongside jewelry, etc., that are ways of taking capital out, right? Because there are capital control restrictions. So sneaking capital out of the country, which is very strict on capital controls, becomes, an interesting proposition. How do I do that? Well, crypto. Recall that crypto consumption in China is extremely high, despite it being illegal, right? Go figure. Because it fulfills a service, it fulfills a demand, it fulfills a function that is not present in a place like the United States. In the United States, because you hold crypto, there is not the same level of fulfillment that, let's say, a Venezuelan was using to escape Venezuela. For example, this was actually more or less a common thing. But one of the benefits of both gold, right, and Bitcoin is that in the case of gold, you can store a larger amount of net worth in a smaller item. But gold is physical and can be stolen, right? It's not that easy to protect it, even if it's on your person. You could be checked. They could find it in your shoe. They could find it somewhere, and it could be taken from you. And the advantage of Bitcoin, and I've explained this on like the whole Bitcoin technically for some countries has a utilization, but for Bitcoin you could store hundreds of millions of dollars in a flash drive or in the keys that you memorize, and all you have to do is get out physically, and then if you still have access to it, well, you have all your money. And so for Americans, it doesn't fulfill the same demand. You don't have that issue that some of these other countries do have. So that's all to be said is like, the observation, like what's going on with silver in the United States, the United States consumer, the Western consumer. This was extremely speculative. A lot of it was driven by, in my view, I think obviously so, speculators who were kind of driving into the momentum, right? So momentum investors, but also heightened, unprecedented demand from China, which is a large market for metals, and why we haven't seen it collapse as much. So that's what I wanted to illustrate here. Okay, and then on that same token, we're also going to talk about the demand for dollar and dollar destruction narrative, and kind of why that's sort of silly. And then we'll talk about software, because then that's another topic I'm excited for. There are companies in Singapore that will allow you to store and trade gold and silver in a similar way to crypto. Yeah, and there's a demand for that, for kind of like digitizing ownership of it, but still, nonetheless, like, okay, but what if I live in the said country and I can't get money to Singapore because like my banking system's blocked? So that presents an issue. But yeah, for an American, it's like, yeah. No, Dan. So here's an example. It's not nonsense, because let's say I live in a system that the banking system itself is closed off. So I know for you it's useless, or for me it's useless because I don't live there. But let's say I live in a system where my banking system is closed off. How do I pay the Singaporean company? How do I purchase the gold in the first place? I can purchase it locally. So I can purchase physically the gold locally. And then how do I get it to you? I get it. Like once I have it, and once you have it stored, it's good. It's there. And now I can go around the world, but how do I start that? If I'm in a system that's super closed off, how do I start that? Yeah. And that's always what I said. That is the one true case crypto. For an American citizen, for a Canadian citizen, for a lot of these Western citizens, there's not that use case. Although some might argue you always want that to be there, so there is a use case. just in case, right? Just in case. And I get that too. But an American citizen typically hasn't had to experience that, and so not typically has not had to experience that, and so it's not really doesn't offer the same use case in that case. But anyways, so coming back to like the dollar destruction narrative, I mean, that's sort of bogus, because we saw nowhere in any other part of the market indicate to us that the dollar was destroying itself. We didn't see that in the bond market. So that's where I'd expect to see it. But I saw this narrative kind of go crazy, and especially among a few European investors who kind of made this like offhand comments about the dollar, like dollar is weak, haha. Like, and then you see it on Reddit, people saying like the S&P 500 was up, and they're like, actually, it's not that up because the dollar got weaker relative to euro. And it's like, okay, buddy, come on. Because if you look at it from a longer term time frame, the dollar is like, its trend isn't really broken. The trend is the same. It goes in fluctuations, and dollar price movement, the ones that we're seeing, can be caused by a multitude of reasons. Especially the recent one has a lot to do more with Japan than anything else. And so I chuck it down to like the dollar movement is a lot of noise. You can make your story to make it make sense in your head, but this is noise. If it was something super serious, you would see it in the bond market. It's not super serious, so you're just not seeing it anywhere else besides whatever headline you're reading, whatever YouTuber you're watching with the fire behind them and going, fire, it's over. All right. It's bullshit, plain and simple. Okay. So now let's get into the meat and potatoes, or not meat and potatoes. We already talked about meat and potatoes, but now it's 2 hours and 12 minutes. So I got to adjust this. All right. 2 hours, 12 minutes, software companies. We're going to talk about software companies. So the last time we spoke live was in early December. By the way, if you guys are enjoying this 2 hours live stream so far, we're probably going to go 3 hours. I see there's 300 people watching right now across the platforms. Wherever you're watching this, feel free to like, share, subscribe, follow if it's on Instagram or on X. And let me know how you guys like it. Twitter and YouTube never talk about how important Japan is. In terms of the, monetary, yes, very important. But I didn't know they don't talk about it. I mean, I guess I have different people I follow, but I think there's plenty of people that do talk about it, but I guess maybe not enough. Maybe that's true. But yeah, Japan is a powerhouse for sure. Okay, so let's talk about software. So software stoinks. Let's go over the big guys. So actually, let's go high level on all software. So let's talk about ServiceNow. And I'll kind of illustrate the point that we talked about in Capital Mindset Club about software. Just sort of the high level overview, then we'll dive deep into some companies. So one of our views, or our main view, I should say, on software, I think is fairly constructive. It's saying that we think that the correction in software is in a large part, due to the regards show up on the algo. Sorry, I was just seeing a comment there. In large part due to the valuation, the starting valuation. So what do I mean by that? So a lot of software companies, we find very perplexing that they're actually not even as profitable as we might think, right? So you think intuitively that software companies are these extremely profitable businesses, but they're not really. A lot of them aren't, at least. And some of them are running almost like charities. I know that's actually blasphemous to say, but no, seriously, we'll actually break it down here. So let's take a company like let's do the bad ones first. Let's do Atlassian. All right, so these guys are effectively a charity. I genuinely don't know how they don't make any money. Okay, so what they want you to do is, of course, they want you to look at adjusted metrics. How Charlie Munger used to call it EBITDA bullshit earnings. Well, like, there is truth to that. Of course, there's more nuance to that statement, but the spirit of what he was trying to say was anytime a company is trying to adjust something, and are they trying to say, hey, look at it this way, you should question it. You should look into it further and say, is that justified or not justified? A lot of times, these companies are utilizing figures like adjusted earnings per share, non-GAAP metrics, or EBITDA, because they are making a very important, very crucial adjustment of removing things like stock-based compensation. So stock-based compensation, by all intents and purposes, is absolutely a real expense. Anyone who says otherwise is an idiot. And stock-based compensation has, yes, its benefits for an organization. Yes, it has cash flow benefits. If you're trying to not go bankrupt and you're trying to save on cash as much as possible, it is in effect the investors footing the bill for that employee. And it also gives the added benefit of tying up the employee potentially for a longer period of time. So talent retention. So there are benefits. It's not saying it's like only bad. There are good things. Everything is nuanced. There's nothing that's black and white, really. But it can get abused very quickly. And Atlassian is an example of that. Atlassian would rather drag their nutsack through shards of glass than make you money. Now, I know that's a very provocative comment, and I did it a little bit for being comedic, because you need a little comedic relief for watching a stream for 2 hours straight. So hopefully it made you laugh a little bit. But Atlassian, in that same metaphor I just provided, they bought a company called Dia. So they're already not very profitable business to begin with. And then they go out and they spend close to $1 billion on a browser. And that's why I made that comment. Because instead of focusing on efficiencies, which in my view could be equivalent to potentially firing a lot of their workforce and focusing on only the crucial needs of said workforce, and focusing on retaining good talent. So treat the employees you do keep very well. Right. And just focus on that. And that's easier said than done. I know what I'm saying is like, oh, yeah, obviously. But I feel like a lot of these firms do not focus on that as much as they should. And so when we look at the stock-based compensation, we should actually view that in some ways as some adjustment we do to the cost of goods sold. Where I mean by that is, like, these employees, if they're important, they are crucial to the research and development of your product. And I'll ask any software developers, not developer, but executive, like, oh, what happens if you stop spending on R&D? Does your business just die? Some of them, the answer is no. There are a few that out there that I know of, but a lot of them, it's not a no. A lot of them, it's they will die. It's a yes. And so the R&D becomes almost like a fixed, continuous need for expensing. It's a continuous investment. And so we should probably think about it. The it also made me wince a bit. Well, unintended consequence, but collateral damage nonetheless. So coming back to the question on R&D expense, right? It's seemingly like a part of the product itself. It's a feature. It's an expense that you have to do to stay relevant. And okay, what happens if you don't pay the stock-based compensation? Because it's like, oh, it's not a real expense. Okay, stop paying the stock-based compensation. What happens? Do the employees leave if you don't equal the new salary payment? What happens? Probably that, right? So in order to remain competitive, you have to increase the pay, increase the cash payment through salary. So it is absolutely a real expense. And it is something that is not represented properly in sort of like the maintenance of the product. So a lot of these software companies from the get-go were trading at valuations that were absurd, because after you actually looked under the hood, unless they were growing at absurd rates, it didn't make too much sense. Atlassian is one of those. Jira is a very widely used product. It shocks me to no end that they are not extremely profitable, because in theory, without knowing too much in-depth detail about what goes into the product, because I'm not a software engineer, it feels like it should be a product that is just making crazy sums of money, but it's not. And that is concerning, perplexing, everything in between. And a lot of software companies are like that. Now, some of the cheaper ones, we'll get to, Adobe. Adobe's talked about a ton on YouTube, a ton on X. It has a lot of followers. And rightfully so. This used to be back in my day, this used to be a darling. So if you were investing before COVID, before all that shenanigans, you remember Adobe as this fast growing business that did this crazy change back in like 2015 or so. Everyone sort of doubted them. And, the CEO had to go on TV and explain like, oh yeah, we're doing this whole new thing, software as a service, subscriptions. And people were doubtful. People were scared. If you invested at that time, you did really well. Even till now, you still did well. But here in the now, what are we looking at? So the PE here is actually the correct PE. It's not the forward PE, but that is the correct gap PE, 17.55. And in my view, for a company that's growing at 12 or so % earnings per share, it should more or less trade on a gap basis, roughly maybe around the mid-teens level. And I think that's fair. Offer it a slight premium for the stability, but asking for 25x times earnings, sure, it could get there. I just don't like a thesis in particular that relies on a multiple re-rate. I don't tend to like those. I tend to find those more speculative. That could work out because the market could pay whatever in the short term for something. Heck, it's paying 50 times earnings for Walmart. It pays 30 times earnings for Apple, growing at 10%, sometimes less than that at times. Well, that EPS growth from them is like heavily. It's also share repurchases too, but it pays. It's the same market that can pay 70 times earnings for a company, 120 times earnings for Axon. All right, we're talking about the same market. Yeah, absolutely. You don't know what the multiple market's going to sign in the short term, but as far as like penciling out a thesis, if you're relying on a high exit multiple, I think it's a weak thesis. But you could say, it's 12% now, but there's going to be growth reacceleration. If that's the case, I'd love to, hash out, hear the argument, etc. And then that becomes an interesting thesis. That actually becomes a really good thesis. So if you're very familiar with what Adobe is doing, and Adobe is working on a new sort of product implementation that is going to reaccelerate growth, oh, well, you have my ears. Let's talk, But if it's simply, it's trading at 17 times earnings, or maybe on a forward basis, trading at 15 times earnings, and then I think it's going to trade at 25 times earnings, then I view that again as a fairly weak thesis. And there's a bunch of different ideas out there. It's like why Adobe is undervalued, and I tend to see it like this one has sort of like my it's a battle. It's not really a battleground. So I think most people agree with it. Well, maybe I don't surround myself with people who think it's a bad stock, but well, that's a lie. There's a few club members who are like, wait, no, I clearly said it was a bad stock. Not me, but them. And you guys know who you are. But with Adobe, I tend to find myself more leaning on the cheering for the bulls. I cheer for the bulls with Adobe. Because I think the company is not going to suffer all the narratives that's assigned to it. I don't think AI is going to kill it. I think that's dramatic. I speak to a bunch of creators on the creative side, various companies, and it's like, it's not going to replace them. They're not going to replace Adobe. There's a lot of cost to replacing Adobe. There's a lot of cost to replacing a lot of software. And Adobe is a specialized software product. So it's not the same. And I think they're going to do well with AI implementation. I think that it's going to be a lot more commoditized in that space, and you're always going to need an interface to interact with it. And in that way, the Adobe interface is very much like a lingua franca, but of creatives. So everyone can communicate easily. And then there's Salesforce. So Salesforce, comes out, and it's like, it's the same kind of thing. It's like actually trading at a higher multiple on GAAP. They would love for you to look at the adjusted figures. They'd love that. But it kind of shrouds the shenanigans that, goes into the cost structure of the company. The company could really do wonders if they focus on efficiency. Absolutely. I think, by the way, before I let Adobe off the hook, I took a look at a lot of what Adobe has in terms of employee count, and by outside looking in, I think that there's a lot of efficiency gains to be had at Adobe. I think that they have too many. I think that's actually the problem with a lot of software companies. They have too many people, not engineers, by the way. Not engineers. If you're an engineer and you're like, look at me, it's like, hey, we had a horrible past couple of years. What do you mean we have to be fired? No, I'm actually not talking about you. For example, Adobe only has 8,000 engineers, but they have 30,000 people. And so this is a software company where, of the 30,000, only 8,000 are engineers. And this is similar across the board. And so there's a lot of bloat in there. Don't tell me there's no bloat in there. There's definitely bloat in there. And then same with Salesforce. Man, they could all decide tomorrow to go through this like whole transition, which is probably an awesome part of a thesis. If like you're starting to develop or you're starting to talk to management, they're saying they are going to do this, then I'm all for it. I think all of these guys can improve profitability. But yeah, Salesforce, don't tell me there's no bloat in that 76,000 full-time employees. It's like, look into it. Like how many engineers do they have? How many salespeople do they have? Like salespeople are very crucial. And typically you can observe the Pareto's distribution in any set that you're measuring, but you got to be careful with that. So like when you're working in consultancy and you're trying to figure out, okay, how am I going to, make this organization more efficient? And then you take like that principal approach, like you're going to look at, do you think of the Pareto's distribution of like the square root number of people are doing half or more amount of the work? You got to be careful with that blanket assumption, because there could be like this little thing that you may not assign value immediately, but that little thing doesn't seem like a lot of work, but it's very crucial. And you got rid of that person. Now that's the only person that knows how to do that. So then you're cooked. It's over. All right. So there's no bloat in Salesforce. Now tell us how much gloat there is in here. Shut up, boo. All right. And then let's talk about and I think there was a question. So let me get this question out on it. This question. So the ones that I really like, okay, and I do like them. And I'll put them up here. So Constellation Software. All right. So this was the biggest compound bro darling of the past 20 years. And oh my gosh, has it absolutely hilariously died. And in my view, is the most interesting of the software sell-offs by far. So there's a few things going on with Constellation. The primary thing, like all the software companies, is the notion of AI making them redundant, AI killing them. I think those arguments are silly, and I'll explain why. All right. So first of all, let's get into what Constellation Software is. Constellation Software is the largest acquirer of vertical market software in the market. What is vertical market software? Simply put, best to understand it, is it's software that's hyper specific to a particular task or business, and it doesn't translate well to another. So it's very vertical. It's vertical. Horizontal can translate to a bunch of companies. So an example of that would be like Microsoft Excel. Microsoft Excel, any company can really use it, whether you're a company that mows lawns, whether you're a company that cleans cars, whether you're a company that is an accounting firm, whether you're a company that, builds HVAC systems, or a company that, builds turbines. Everyone can use Excel. But let's say a software that counts chicken eggs. Well, an engineer who works at Lockheed Martin, not really going to need software that counts chicken eggs. Probably only going to be used by chicken farmers. So that's the example I'll provide for vertical market software. And there's a bunch of them. There's an immense amount of vertical market software solutions out there. If you have a small business, you may know of one that works for your small business, and you're like, wow, there's a software we use. It does this one little thing and it's only dedicated to that one little thing. And typically it costs roughly 1%, or it's about 1% to 2% of the operating expenses of any business. So it's not very much top of mind when you're thinking of your budget for the year. You're like, oh my gosh, I have to make cuts. Well, that software is definitely going away. So that's a little bit of the characteristics when we think of with VMS software solutions. And then in terms of what they do, it's extremely vast. Like, the world's very big out there, and you realize that when you read the history of Constellation Software back in the day, when they were still growing really rapidly, which they're still growing quite rapidly. But back in the earlier days, there was this question brought up, like, okay, you're buying all these companies, but like, how many are there? And then Constellation was like, there's a lot. They released numbers back in the day. I think it was like 2015 or so. They're like, yeah, we think there's like 100,000 companies out there. And then that makes your jaw drop. You're just like, what? There's 100,000 companies that you could are in your wheelhouse of acquisition. It's like, yeah. And then that number's only gone up because there's more companies being made, et cetera. And going to the actual crux of the issue of like, oh, software, this software is dead because now anyone can make the software. Well, let me start by saying, and you can appreciate it. You just talk to some software engineers on this. It's like, actually, I'll say we have one, at least one, but the one I've spoken to, who works at one of Constellation's business units. And the conversations I had with them were very insightful. And actually, in terms of the metaphor or the analogy provided, it's true. It's like, well, the problem that these companies have always faced since the very beginning, right? Since forever, is that they're not very complicated software products. They're not. That's not their strength. Their strength is not how complex it is. If there was a software engineer, there is someone who can make a competing product, if you get what I'm saying. So the software that counts the chicken eggs, there was nothing ever stopping anyone from creating a competing product and just offering it for less. There's always the potential that was going to happen. And that was actually an original a risk question from back in like even before my time when I started investing. Like, that was a thing that early Constellation Software skeptics had. Was like, this is not competitive, or there's no moat here, because anyone can create the software that this this company is using. It's not a difficult thing to replicate. Yeah. Yeah, because that's not the friction point. The friction point isn't in the difficulty of it. The friction point comes from the crucialness of the product, and also comes down to when they're thinking about things to change, it's not top of mind. So there is a reality where you have people who are very finance oriented, who are very think of everything in terms of like min-maxing, and it doesn't translate well sometimes into reality. And that you get from running a business. So when you run a business, there are things that you focus on that are important, and there's things that you don't really focus on that are not that important. They're not worth your energy. One of those being something like if I am running a business and I'm a chicken farmer and I have the software that counts the chicken eggs. Well, the last thing I'm going to do is, and it costs so little of my operating expense, the last thing I'm going to do is think about cutting that versus anything else. It's probably one of the last things. It's probably the last thing I think about cutting. There's everything else that's in front of it, and that is probably more under my control. And also, when you think about that exact example, the crucialness of it, I can't afford any change in my order of operations for my chicken business where the eggs are miscounted. Think of the second order effects of a failure point there. So that's the characteristics a lot across the entirety of Constellation's portfolio. But yes, the original, so this is like OG, bear case, or not bear case, skeptic argument for Constellation was like, yeah, anyone can replicate it. It's like, oh yeah, duh. And so it's kind of funny that it's returning, but in a different form. It's the original skeptic argument, but with new makeup and a new like hairstyle, because now it's AI will just do it, or someone will just grab it in AI and it's super easy to make. It's like, no, it's never been hard to make. It's always been easy to make. And you're just like making more of the case. If anything, the real argument here is for Constellation itself. It will be a lot easier for them to maintain their portfolio, for them to deploy updates. And so things like Claude get really interesting because, Claude or other products, Constellation will be, I think, best suited to deploy those assets into their organization, and then from that maintain their portfolio easier. And the price actually coming down. So one other thing about Constellation that's really awesome, right, is their strategy for employee retention, their strategy for stock-based compensation. They view it completely different than most companies. So like I said, nothing is black and white. Nothing is all bad. Nothing's all good in the markets or in companies. Like everything is done for a reason. You got to analyze it. It's not just, but everything can be abused at the same time. So like I said, stock-based comp has its place. It's not always bad, but Constellation has a very different philosophy of it that I appreciate, and I'll explain it now. So Mark Leonard views, and I think he's right here, that equity in the business is the most expensive form of capital you can possibly use. Why? Well, if you think about it philosophically, let's say you own a business and you believe in your business. You think your business is going to grow into the future. If I give you shares, then instead of cash, and I did a podcast on this explaining dividends versus buybacks, and why, selling shares and dividends or cash, it's not the same, because people equate it to the same. It's actually not the same whatsoever, because shares are representation in all future profits of the business, and cash is cash. Cash has no value beyond its immediate value. And so if I give you shares, I'm giving you ownership over all future cash flows of the business. Whether or not it's overvalued or not is a separate question. In principle, though, it's equal to the present value of all future cash flows, around there, right? Because it could be overvalued, it could be undervalued. So if I give you that, and if I believe in my business, if I think my business is going to be like amazing, right? Then that's an expensive form of equity, or the expensive form of compensation. And Mark Leonard views it that way. And you know what? He's right. He's right for the most part. And then so he does, though, he wants the employee to be invested in Constellation, because that's the benefit of SBC, is like you get that employee, and that employee is like, oh wow, I'm also an owner, and so I want the business to do really well, and I'll stick around. I won't jump ship. I'll stay here. I'll make sure I do a good job because I want the business to grow. Well, Mark Leonard thought of that too. He's like, yeah, that is the benefit of stock-based compensation, but I don't like the whole giving equity part of it. So what I'll do is I'll pay them cash, more cash, and part of that agreement in their compensation, part of that compensation has to go towards buying and holding the shares. So he kind of created this best of both worlds in a way. Now, the one thing where it's like, okay, what's the downside? Well, the downside comes from Mark Leonard simultaneously believing that stock buybacks are immoral. And so for all of its history, right, that's never been a problem, because it's been in like this growth phase, and it's never really had this like horrible narrative. Now, when the share price is in free fall, yeah, it would be kind of nice for Constellation if they exhausted opportunities in a given quarter to say, hey, our stock price is cheap enough right now. We'll take a snag at it. But arguably, it's not that much of a problem, because the present opportunity set is greater perhaps than the actual purchase of the shares themselves. Now, we'll get into the valuation. So the valuation right now is pretty cheap, especially from historical standards. So there's a few things you got to know. So there's free cash flow, which is one figure, and that's represented in a consolidated basis. And then there's free cash flow available to shareholders, which is actually the one that Mark Leonard says you should use, and the one that you should more appreciate, because that's what could be distributed to you in theory. So not to be confused with themselves, because there is one thing about Constellation, and that's complexity. But for all of its business units as well, this is also true. You want to be using free cash flow available to shareholders, and that's cited in the following question as FCF A2S. And so you'll see that in the reporting. So one adjustment you have to do, because then it doesn't end there. It's like, but only really for Constellation. So the other ones get a little simpler, but Constellation has an adjustment you need to make, and that's from Topicus. So when they acquired Topicus, they also entered into an agreement with the family that owned the majority share, that it's in effect a call option for Constellation with a term limit for Constellation to acquire the remaining shares. And the remaining shares are in an undisclosed multiple range. Well, we know what the multiple range is, but we don't know what factor affects the multiple. We only know that growth affects the factor. Let me take a water break. Give me a second. Okay. So the adjustment will vary, but it's in some form of calculation that, depending on the growth rate Topicus has, will also adjust the liability, which represents what they have to pay out in cash, but it's a one-time expense, or it's not even an expense. It's a one-time investment. It's just a cash outlay, but it's not an expense. It's an asset purchase. So you got to think about it completely differently. It's not viewed. I would never view that as an expense. And if you look at the total multiple range, it's super appropriate. It's some factor net of all expenses, by the way. It's net of expenses. A multiple of what TOI Topicus is earning. So after you do that adjustment, I'll just cut to the chase. It's trading at roughly 20 to 21 times. So 20 to 21 times free cash flow available to shareholders off after a honest adjustment to that. So that's historically extremely cheap. Now, the question is, what opportunity set does Constellation have in front of it? Well, I expect they're still going to grow in line of 4 to 5% organic growth. That's been pretty normal, maybe a little bit less. Arguably, that's the top side of what I just said is the top side of what they'll achieve, but maybe a little bit less. And then inorganic growth, like I said earlier, or alluded to earlier, most of the time I will always prefer companies with organic growth to inorganic growth. There are exceptions. There are a few exceptions. And the few exceptions really is actually industry exceptions, because it's not really same company or same competitors. I will always prefer organic growth, but the exception lies in VMS software. And it's competitor Roper Technologies, which maybe one of you would have thought of this question, maybe not. So Roper Technologies, ticker symbol ROP, has traditionally had higher organic growth ever since I followed it from Constellation. And you would think, okay, you would prefer Roper, because I'm mentioning them for that very exception, because Roper technically is a little bit different. They focus on bigger ticket purchases, oftentimes, in the much larger scale, like 10 times, even more than what Constellation typically acquires. And they don't even have that many products or businesses that they've acquired. You actually can follow and keep track of Roper's businesses much easier than Constellation. So some of you might see that as a benefit. But Roper has always had a higher organic growth, but Constellation has more than made up for it with inorganic growth. And in this instance, where both businesses are really supposed to be serial acquirers, I'll take always the one with the best measured IRR. Which business is returning a better return on investment on deployed capital? Because you almost have to view these holding companies, these VMS businesses, as holding companies that are deploying capital, like similar to a Berkshire or any of these other businesses that you're expecting them to invest your capital for you. So Constellation has had the best, or among the best. There's actually probably one out there that's better than them, but among the best internal return rates on invested capital that they've deployed into these various businesses. And their hurdle rates have fluctuated over time. So we've seen, more aggressive hurdle rates. We've seen more conservative hurdle rates. And that adjustment is observable, you can see it when Mark Leonard speaks on it, right? And those adjustments have changed as their size has changed. So when they're pursuing larger businesses to move the needle a little bit more, that hurdle rate has to go down a little bit. But when you're pursuing businesses that are maybe like $1 million in size, well, the hurdle rate can be quite high, because first of all, with like a small purchase, not a lot of eyes on it. Lower valuation, higher implied IRR potential. So yeah, that's the gist. And with Constellation, there you can't stop but mention the little baby businesses, the satellite businesses, the children of Constellation, like Topicus. So Topicus is probably my favorite in the whole family. I meant to use the other one, but anyways, the same thing. So this is the ADR. Let me see if there was any question. Then I'm going to accidentally skip any. We'll talk about Dual. I'll star this. I saw there were a couple questions about Dual. And then this follow-up question, I'll start. So I kind of put it together. Okay. So, all right, let's finish up with Topicus though, and the software. So Topicus is I prefer it over Constellation if you had to force me on it. One of the things about Constellation too is they have a culture of experimentation. That culture of experimentation is seen in the differences you observe between business unit to business unit. So Topicus has focused a lot more on internal growth, organic growth, rather than purely acquisition. So their experimentation is like internally, they'll try their best to develop in-house VMS solutions for the market. And then they'll use their connections and experience to sort of look at what demand there might be, and they're a perfect example where AI could actually help them in that endeavor. And so that was something that was unique to Topicus as far as the culture goes. Topicus has a little bit of complexity too. So there isn't, like, again, if there's a drawback to all of these companies, there's a little bit complexity. But they have a large ownership of another software company. I can't remember the name right now, so apologies. But it's a Eastern European software company. Same thing. So it's not like they're doing a completely different thing. And their focus is on that market. So this creates a really fantastic sort of partnership between them and their subsidiary. And that company, of which I apologize for forgetting its name, pays basically all of its earnings out in dividends. So one of the benefits of that is, like, well, the cash flow just goes directly to Topicus, and then Topicus reinvests it into other businesses. So for Topicus, it's whatever. It's almost the same thing as if it was these other businesses. But they are also focused on acquiring different businesses over there. And then when they work together, they can spread cross-pollinate, is one other way of saying it, the software solutions across the different markets. And then, yeah, Constellation offers to Topicus its access to its resources. And that's sort of like what Constellation is focused on, being the mothership. And so within Constellation, you have these other business units that are still not public, and they have indicated that they are going to be spinning off more. So for now, you have Topicus, Constellation, Lumine and Topicus being the two spinoffs. I believe the next one that we know of speculatively is going to be the one in Australia. But yeah, no, as far as like a software company, I think VMS is still here to stay. And I think AI is going to improve the margin profile, and it's not going to actually end up being a threat. So I stand on the side of, pro VMS. And disclosure, I'm long Topicus and Constellation. And I'm viewing this as like, I'm just nibbling. I'm watching this falling knife. And so there's just like, okay, I'll buy a little bit more here, buy a little bit more here, buy a little bit more here. Nothing too commitful, right? Because there is no catalyst. And that's something I should stress. You think the valuation is cheap now on a free cash flow or on a free cash flow available to shareholders basis. You think it's cheap now? Oh, it could totally get cheaper. So do not underestimate the market. The market can sell Meta to single digit multiple. If the market can do that, the market can do that to a lot of other companies too. So do not underestimate the market and its ability to sell things off. And like I said, I've already spoken about Dave. Dave is trading at a single digit free cash flow multiple, and it's growing at the rate it's growing. Not surprised. Like, is it somewhat surprising? Absolutely. Of course it is. But also at the same time, if you reflect on that, it's also not surprising. Like I just said, Meta 2022, of course, yeah, you're like, wait, hold on. 2022 was also, the bear market. So, 20% drawdown for intra-year for the market. Of course, crazy things happen. Yeah, I get that too. But so there is some nuance applied there. But software, you told me, Constellation gets down to 15 times free cash flow available to shareholders. Then I really wouldn't be shocked. I really wouldn't. And same thing, we just spoke about Adobe. Like, you think Adobe won't go to, 15 times gap, 13 times gap, not adjusted, because that adjusted, I think it's already at 12 times earnings. But you don't think it could get there? Oh, yeah, absolutely. The market could take it there. Now, as an investor, you have to view it as like, does it shake your thesis? I think for the most part, the longs I've seen on Adobe, I don't think it will. And so, they're going to toughen through it, and it will, do its thing, and efficient markets will prevail, but over a longer time horizon, not the month to month, day to day. And that totally is my view on things. Okay. So Mohammed, on Roblox, I just genuinely, like, I'll be honest with you, I don't get it, but it's because like I gotta be sat down and explained to it like a child, if I'm being honest, on Roblox, because I know that you've done a lot of due diligence on Roblox, and I admire your extreme confidence and passion for Roblox. I just don't understand it myself. Doesn't mean I don't want to understand it. It actually might be too complex for me, where I don't understand the product at the end of the day. It could be a generational thing too. But you know, one of the things that I can't get past, and I've spoken to you about this, like I have trouble with the way management compensates themselves, or you know, everyone internally. So when I see that, I'll give you an example, because not to pick on Roblox, it's not to pick on Roblox. Let's talk about Axon. So Axon, great business. Like, oh, this is a good business. All right. This company, wow. Like, yeah. And also great returns. But as a business, oh my gosh, this company is like, mwah, you know. But, you know, I said but again, I'll say but 3 more times. But um, I can't wrap my head around the stock-based comp. The stock-based comp is equal in some quarters to the free cash flow, or to the operating cash flow. So I'm just like, dang, like how forward, I know I have to be forward looking, but how forward looking do you want me to be? Like, come on. Because it really is crazy. Actually, let me use our, oh, you know, great plug for our sponsor, finchat.ai. No, I'm kidding. But no, seriously, sponsor if you want to support me, finchat.ai. Link in the description below. You get a discount if you use it, and I also get a nice little kickback. So, yep. Okay, there we go. I have to refresh. All right, so there's 2 ways. While I'm getting this out, there's 2 ways of supporting me. You could super chat me. You know, that's one way. You could join the Capital Mindset Club. If you're an accredited investor, you know, you can always contact me about investing in the fund, but that's only if you're accredited. But yeah, you can join the Capital Mindset Club. You can use the sponsored link down below, or you could send me a super chat. But let me get to the Axon stuff. Okay, so let's get the financials. Let's go to cash flow statement. Let's go to share base. Like, this is ridiculous. All right, changes in the cash flow from operations. Like, wait, let me make sure it's not in quarterly. Yeah, it's an annual. So like, and I know Dan's in the chat. So Dan, I know you said they have no indication of changing this. Actually, look at that. The same thing happened back in 2021, and it did fine. Hey, that's the argument. But yeah, so this is something that, you know, not to pick on Roblox, but this is honestly just, when I see this, it's I don't know what to do. I don't know what to do, because it gets really hard for me to value, because I get it. Like, I have to be super forward looking, but like, come on, how forward looking do I have to be where I start to, you know, ignore risks of execution? And so it's like, yeah, you know, in theory, if they gobble up the entirety of the police budgets, right, and they're in every police station, and they're in every Nordic police station, every Anglo-Saxon police station, every European police station, every Western police station, every global police station. Like, I get it. Yeah, that TAM huge. Oh, I get it. Like, you know, oh, drones, new product line. Oh, you know, call center management, new product line. Totally get it. And lots of growth implied, but the growth is not, you know, it's trading at like 100 something times earnings. The growth is not 100%. The growth implied, still great, still really good. It's like 30%, just under 30%. So, I mean, you know, and you're just like plowing SBC out there. You're just diluting. And I look at this, and when it's greater or equal to, most of the times, to operating cash flow, it's like, dang, you know, it's like the investor is really footing the bill. It's almost like a startup. That's what it feels like. It really feels like a startup. And you think like, okay, but the thing is, the management, I get it. There's no reason to change this. The market isn't punishing you until it does, right? Market doesn't care about anything until it suddenly does care about some things. That's the way it works. And it's kind of funny that way. Like you look at some companies and you're like, oh yeah, that's kind of expensive. Market doesn't care, keeps it overpriced for years, and then suddenly cares about it. Constellation, we just looked at them. Like they were expensive for many years. Mark Leonard would often come out and honestly say the stock is overvalued. I don't know what the heck's going on with it. Sometimes he would be like, it's 1/4. It should be 1/4 or half the price, and it kept going up. So it's not like it's a good prediction of where the stock's going to go, but there are times where it's like market, I guess, doesn't care, and then you wake up one day and it's like, oh, market cares. So I feel like that way when I look at Roblox, this is on the comment on SBC, on Axon. I also feel that way about Atlassian. Like the same thing is true for Atlassian. So it just feels like, what are these charities? Who do they serve? Do they serve the shareholder? Do they serve themselves as a management team? Are they a daycare for people to collect a nice fat paycheck? So of course they will change, right? They will change in terms of like behavior if the market punishes them. That's how a lot of management teams are. Yeah. So I'm just going through all the comments I have starred. By the way, if you have a question, I'm not looking at the live comments right now, but if you have comments, I'll go through them in a second. And questions on things, I'll go through it and try to start. And don't feel afraid to repeat a question because, with everyone's comments, I'll miss some. So I don't count that as spam. I don't have like any, I have a nuanced approach on spam. If it's actually spam, I'll do something, but if it's a repeating of a question, that's not spam. So don't feel afraid. Okay. So yeah, there's a lot to go through. Good evening, Fabio. Does this count as a contributions for the fund? Oh, in the heart, it does. In the heart, it does. Thank you. All right, completely off topic, but did anyone see? I should actually put this in the Q&A. So we are 2 hours. We're going past 3 hours. We're going past 3 hours. Oh man. Yeah. Estabula says, no one could say it's not out of the love of the game. All right, completely off topic, but did anyone see that MSTR is officially down on their cumulative Bitcoin? Oh, I got another fact for you. The aggregate cost basis of Bitcoin. Don't know if you knew this or if you're still here, but the aggregate cost basis of Bitcoin is roughly in the 80-something thousand. That's pretty crazy, right? And I know that MSTR is because people kind of go in and out, and that's how that happens. A lot more people got involved. A lot more like retail got involved at higher prices. There are, of course, whales that have had Bitcoin for a long time. Not talking about those, and that's a little bit of survivorship bias there. But a lot of retail, your average Joe who's like, yeah, I like crypto. A lot of them got involved. Don't kid yourself. Not too recent, or have traded in and out, and so have now an aggregate cost basis system wide of somewhere in the 80-something thousand. And so that wasn't a problem when Bitcoin was like 100-something thousand. Everyone was like, yeah, I'm happy. Now, remember, now you have a lot of trapped buyers. You have people that are like a little nervous. And remember, there is nothing holding up Bitcoin besides more buyers and sellers, and more sellers and buyers. It is purely a non-fundamentals price behavior driven instrument, entirely derived its price day to day from the relationship between buyers and sellers. No question about that. I will debate that to the grave, and no one can argue otherwise. So now on the question of MSTR, this is, so Andrew was briefing me on this because he's seeing a further concern and deterioration for all the Bitcoin banks because as it approaches below their cost basis, and now they're trading below book, and if some of their debt starts to infer stress, then you could have a forced selling event, or a forced selling event below NAV, and could continue to put pressure on the price of Bitcoin. So like it also puts in the consideration, like if MSTR sells Bitcoin at a loss that it's trading under NAV for now, and then uses that to repurchase stock. That same selling of Bitcoin can, and especially if it's public and everyone knows it, it could have a dramatic effect on the price of Bitcoin. You could quickly see everything cascade down even lower. Because like I said, this is like a situation where we're entering like a trapped buyer's dilemma. We have trapped buyers who are looking for the door, and that door is also looked at by others. And if more people are looking at the door than not looking at the door, then you have a problem. So, you know, and that's it. There's no buybacks coming on the horizon. There's no Bitcoin buybacks. So in some companies, right, you know, like Jackson, disclosure, we're long Jackson. And here, I'll show you the stock price of Jackson. Jackson Financial, a cool little boring company that continues to just grind higher and higher and higher. This company, if you don't buy the stock, they'll buy the stock. Their buybacks have been monstrous. And so this is an example of, you know, fundamental driven price increase. If again, like if you specifically do not want to buy the stock, don't worry, because the profits are real. And in Jackson's case, which Sabula asked a great question. Hold on, but what about PayPal's buybacks? Well, PayPal never got as cheap as Jackson. That's also a caveat. So Jackson this year is going to return about $1 billion to shareholders. It's an $8 billion company. The multiple Jackson traded at from a starting point was much lower than PayPal's. PayPal is just now getting to below 10 times earnings. I'll give you another example. So mortgage insurers, so like an MTG, because an NMIH is still on like a more of a growth path than MTG. MTG is more mature, but this is another company that if you don't buy the shares, they are going to buy the shares. NMIH will eventually be the same way. It's just going to take a little bit more time because they have to. They're focused on shoring up reserves for growth. But MTG has enough reserves that they don't really care. So MTG, Jackson, MTG, if you don't buy the shares, they're going to buy the shares. They're repurchasing 7% per year. They're trading at under 10 times earnings. And so PayPal, by that same token, if you want a similar effect, right, you do need to trade at an appropriate multiple where the effect is truly felt. Because PayPal would only be, you know, very impactful if you did see that like re-accel, because that's why the re-accel is so big for the thesis. If you don't think PayPal has a re-acceleration, it's not going to be the best investment, by the way. Like that's the thing. So a lot of retail who are price anchored to like $100 a share or more, they have to expect growth reacceleration. You're not going to get there without that. You're not going to get a company trading at 20 times earnings when it's only going to grow at 10%. It's just not going to happen. You're not Apple. Like there are exceptions to that, but generally speaking, you're not going to get that. Apple has garnered this sort of like respect for quality that PayPal will not get because it's not a Visa. It's not a payments rails. It is in a competitive industry. It competes against the likes of Adyen, so Braintree and Stripe. It competes against the likes of everyone else who has a checkout button. That doesn't mean they're like dying. Those are not to be conflated, but they're not going to command a premium just because. So and so like when you're dealing with the starting point matters a lot. So Jackson traded at an extremely low multiple. Therefore, the buybacks were very impactful. NMI, MTG, NMI is not doing that many buybacks. They're doing 2 to 3% per year. MTG is going like 7% per year plus the dividend. So you're getting a lot of capital return. Hence, like say, if you don't buy the stock, they're going to buy the stock. Bitcoin has no one buying the stock. If no one buys the stock, no one's buying the stock. Or if no one buys Bitcoin, no one's going to buy Bitcoin. So you need to have that underneath you. Okay, so And so you can't wait for this pyramid scheme to violently unwind. Yeah. I think a lot of us are waiting with bated breath. Okay, so I believe you mentioned you were long CSU and TOI at a significantly higher price than today. No, so with TOI and Constellation, it really has been sort of like this in and out, bated breath, sort of like I'll wait and see. It's a falling knife, and it's not really about trying to per se time the bottom on like a committed buy. Long story of saying, I have some shares. The last time I spoke on TOI and CSU, which I think on a public live stream was quite some time ago. Like I always say and disclose, I could be out of the position the very next day. But since then, I've also re-entered the position, and have taken the approach of bated breath, where there's no catalyst, appreciating there's no catalyst. So with a over $2 million in personal port, it's not even like point something percent. It's going to be a accumulation period where you're kind of just waiting for any catalyst to emerge, which there isn't one. A catalyst could be an earnings report where they have a proven proof of concept, a collapse in AI capex, or another company per se, sort of illustrating the wrongness of the narrative in question. And so until that point, you have to invest in this name if you want to own it, with the expectation that it could go down more for a variety of reasons, and appreciating that you're not buying a company at 10 times earnings. You still are buying a company at 21 times free cash flow available to shareholders. So you include the risk of growth deceleration. If that happens, Constellation could collapse much further. And so you do not want to be overexposed to that. So let's say AI doesn't, it hurts their growth, hurts their ability to acquire. Let's say that narrative comes true. There is not 21 times free cash flow available to shareholders implies there's going to be a lot of acquisitions, or a decent amount of acquisitions, similar to their current trajectory. Because sure, 50 times, ridiculous. They shouldn't be trading there. 20 times for 20% implied inorganic growth, that's fair. 10% inorganic growth, that's not fair. Down she goes. So that's the risk you got to be paying attention to. So yeah. Do I own or like SoFi? We do not own SoFi. We do like SoFi. I used to be a SoFi hater. I was wrong completely on my SoFi dislike. And I think it was more so tied to the caricature of the SoFi investor being and this is something, again, our partner Michael, who he's the go-to guy for fintech. You're not going to see him really unless he wants to be, but most of the time he's too busy to come onto the public stream. So you just get me and Andrew sometimes. But he's the one who changed my mind, for sure. Completely his fault that changed my mind. Because of course I'm not from that background. And so to me, it was more difficult to understand. But he agreed with me on the one sense. He thinks that the representation and discussion surrounding SoFi by most public figures, it's kind of like they bet on the right jockey, they bet on the right company, but like the rationale at times is annoying even to him. And so, but after learning more about the opportunity set and like what they actually are doing underneath the hood, there is a lot to like there. And it's in a similar vein to how the company has progressed dramatically well in terms of marketing personal loans. So because what they've done with personal loans, which they've turned it from a weakness to a strength, they integrated a lot of third-party capital, turned themselves into a much more balance sheet light business. So taking partnerships with private equity, they now can offload, and it becomes more of a velocity game again, right? They're not holding a lot of the loans on the books anymore. They don't have to. They can take a lot of this third-party capital and turn it from interest earnings to fee-based earnings, which is a higher quality source of income. And then you also take the fact that, the student loan business, which is coming back online, it has come back online in a meaningful way. That business should more or less be relatively stable to growing over time. And then you have the consumer banking business, where there is actually a lot of untapped potential and opportunity from the underbanked, from the misbanked, actually is the better way, not the underbanked, because the United States, we don't really have underbanked, we have misbanked. So people who have needs that are not being met by their current bank. Now, there are, obstacles along the way, and that comes from, in the case of like Galileo has a problem. The problem with Galileo is that it's attached to SoFi. What do I mean by that? Well, Galileo is a offering to SoFi's competitors, which makes, and we know this for a fact because through sort of like indirect channels, we've spoken to folks who work or have founded these competitors and are active competitors to them. That is also their thought process. Their thought process is like, hey, like, Galileo, you're part of SoFi. SoFi competes against us. I don't feel comfortable with that relationship because you are seeing everything we're doing on a very intimate level. What is stopping you from copying our products, copying our innovative solutions? You're seeing exactly how it works. That's a problem for me. I'd rather go with a third party that is just third party. They do not have a vested interest in the same line of business that we're doing. They just have a vested interest in us succeeding. I do not like that. Sam, I am. Anyways, I had to do another little joke. It's 3 hours. So that's our view on SoFi. We're really bullish SoFi longer term. We like what they're doing. I don't like so much Galileo integration. I think that just like makes Galileo a weaker product, not a stronger product. But that being said, there's one benefit. Internalizing that for SoFi is actually a good thing. So that's where it's like a difference. And Chime, I'll say it this way: Chime is an example of a company that left Galileo and is in the process. Like, we'll be seeing them leave Galileo actually this quarter. And actually, I didn't really get a chance to look at that detail of the call if they were talking about Galileo, but Chime should be completely off Galileo this year. And we thought that was going to be near-term bearish, but I don't think SoFi might have not fallen because of that reason. So we were right, maybe for wrong reasons. And we were looking for an opportunity to look at investing in SoFi because we thought $30 a share, it's kind of crazy valued. So it's not really a question of the business succeeding over time. It is now, and especially that's true after their transition to becoming a bit more fee-based. It is now a question of the valuation. And so those are my updated, well, it's been my updated thoughts on SoFi, but yeah, long-winded answer to answer your question. Can you talk more about the sell-off for financial? Okay, so we talked about that too. Oh, Intel. Okay, so start off, disclosure, we're long Intel. So Intel, this business has been a fascinating turnaround. One that at one point too early, and then now at this point in time, I think this is more or less the real turnaround. But really patient on what's going to happen end of this year, because I think if you're wanting results this quarter, which I think that's what we saw with the sell-off and was an opportunity to accumulate a little bit, the end of year is where we should start to see a lot of the benefits come forth. So Intel has been plagued by a ton of issues over the years, a lot of it stemming from Foundry that has put their architecture business in a bit of a problematic state as well, where they've had to actually even outsource production. So Intel is also super lucky that they are also in a time period where there's unprecedented demand for off-the-shelf silicon. They're also super lucky that they're still in the number 2 spot for CPUs. And debatably, depending on what generation we look at in the future, they could end up being number 1 again, neither here or there. Point being, they're very lucky, because if it happened at any point in time in the past, they would be maybe destroyed. It all started with the investment from the United States government into Intel, and that was this initial hype. So when you saw, I'm going to do candles. When you saw this initial rise was in this gap up right here, the United States government had taken an investment in Intel to the tune of 10% of the business. And in exchange, Intel received a lot of cash that was necessary for the investment in their fabrication business. Fab is making strong progress, and there's a lot of rumors on new partnerships. TSM, which disclosure we're long, and that's our largest play in this, is by far and away right now the best fab business in the space. You can't really do better than TSM right now. Intel has the potential to have sort of like this offshoot catch up to TSM because there's so much demand. It's not true that TSM can fulfill all of it. I know this because you can hear it from TSM. They are able to increase prices, and they have to increase prices on good customers like Apple because the other customers are so desperate for allocation, they are willing to pay a lot for that Taiwan Semi allocation. So that being said, Intel has the opportunity here to just not suck, and then they're going to get some business there. Also on the CPU side, when we move on to the next phase of artificial intelligence, which is more so to do with the agentic revolution, which you're already seeing, that is going to rely a lot more on CPUs than before. And this is why NVIDIA is also working on a solution for this too. So that's made to be a bit of a concern for Intel. But that's easier said than done. The CPU production is also notoriously difficult to actually create something that functions really well. And a lot of these solutions for this is still running on x86, which Intel does very well on. Intel has also been able to exemplify a bit of pricing power in the commercial side for CPUs, which is the illustration of what's starting to show up as a positive. And one thing about Intel that we can look forward to is if you estimate a recovery, that's what a lot of the growth is initially is going to be, a recovery to the earnings profile of before. It's trading at roughly old-time earnings of like 10 times because it used to generate a lot more in profit. And then beyond that, I could definitely see them returning to a new higher growth rate or a new high for earnings. And that brings us to, what the forward projections on valuation might look like in the future. Well, if you tell me that, oh, I'm sorry. I just came back to the comments, zoom in the graph. It won't let me zoom in. Oh, there we go. Now it does. Okay. And let me go to candle. I apologize because on my end, remember, I'm at a different resolution than you guys. So for me, it looks normal. And then on the recording, it looks off. So for Intel, what I sort of expect from them is like, if you told me this company is worth $500 billion before the end of the decade, not surprised. Would not be surprised whatsoever. It's sitting at $200 billion now, so that's roughly a double. But also, given the opportunity set, if we see a lot of demand still for capex, not surprised. Also, if you even see a $700 billion market cap, because again, the first iteration, the first recovery bits to prior earnings, that's how you quickly get to at current price 10 times earnings. If you're trading, if your solutions are, for example, a leading product in the CPU space, you start having a more compatible or more reliable business in the fab space. There's so much demand there. You could end up seeing further earnings growth rate beyond just simple, recovery. And at that point, Intel $700 billion market cap, it doesn't surprise me if it ends up getting there. But let's start with like first the recovery and seeing it get to 500 billion, which would be roughly around $100 a share. So up until now, it's had a great run. And so if you've been long Intel, you've been rewarded. If you were long Intel, I know one of our members, he's been long Intel while everyone was like horrified of it. So it was like before you saw any progress, and they were a big believer, and they've been rewarded. But you bought it basically at its darkest moment. And again, you should be rewarded for that. Then if you bought Intel before the recent run up or in any prior run up before, recently, very recently, you're basically expecting now, and that's what the market I think is, these agreements to start coming out about the fab business. We have a few rumors. We have, NVIDIA also investing in Intel because if you're NVIDIA, you have a vested interest in another fab player, because otherwise TSM can just like roll you over and do whatever it wants with you. And Samsung is too distracted and not focused oftentimes. That makes their fab business, you would prefer it to be Intel. Intel will provide a lot more localized production capacity in the United States. And so understandably, NVIDIA looks at them and saying, we would like to support you to kind of bring you up so we can put our main supplier in check a little bit, because they're having a little bit too much power trip. And so easier said than done. Doesn't mean Intel will succeed. They could totally fumble. They could totally fuck this up. And if they fuck this up, it's entirely their fault. This is their battle to lose, because there's a lot, going behind them. And then you also have rumors of Apple making a potential investment. That could be another like leg up in sentiment. So you could see the stock rally on that. But, that's a little silly reason to rally. But not entirely silly, because it also implies Apple has a vested interest in their success. And I could see that being, important for the thesis. Okay, trying to see if I didn't skip over anything. Yes, I did. I saw your comment the other day. Oh, absolutely can rebound for this drop. The Microsoft hate is just, has to do with OpenAI. Okay, let me come back to the sell-off comments. So that was Intel. Okay, let's talk about Netflix. So I had a question on Netflix. So Netflix is another one that, if you've been an investor in Netflix for a while, you're just like, whatever, right? And at this point, like this was the real man's dip. This is a dip for ants. But in all fairness, so this dip here has a lot to do with just like the concerns people have about Warner Brothers Discovery. This acquisition brings a lot of complexity to the investment thesis. Before, the investment thesis was super simple. It's just subscriber growth, price increases, unit economics, massive operating leverage, beautiful, chef's kiss. Now you start to introduce a little bit of leverage. You turn a fantastic balance sheet to something that has a little bit of hair on it. I think it's fine. I like the acquisition a lot. In fact, I think there's an opportunity to add to your Netflix position, if anything. And so I've been taking the liberty of doing that. I think Netflix here presents a great, or not great. It's not the best opportunity. It's not the same it was in 2022 for relative comparison, but in what's offered now, this is a safety business. This is a stable business. This is, I would discuss it in the same vein as I would company like Progressive Insurance, like an insurance company. It's not obviously insurance, but the revenue stream is extremely predictable. It's one of the last things people cut. We've seen that already. And so, in spite of the fact you might see some consumer weakness in the future, because I don't think that right now, like I said earlier, even though the vibe session we saw was perhaps like we were in a recession in 2022 and we came out of it. And we had this rolling recession ongoing because the United States in particular got very lucky with the AI investment that brought us out of it. Other than that, like, I think we would have been like the rest of the world, where the rest of the world went into a much more remarkable slowdown. And remember that the US, if it doesn't slow down, and in this case it didn't, it actually got lucky, it also picks up a lot of the world, because we are the consumption fulcrum of much of the world. But anyways, coming back to Netflix, it's not going to be one of the things that people think to cut first. In fact, I don't know how many of you have tried this. You can try it. Netflix is perhaps the easiest subscription to get out of. Like you can go try to do it. It's very easy. It's not like Adobe, I promise you. And by the way, Adobe gets a bad rap. Like I baited, not I baited, but one of the members baited me. In fact, it's like, oh yeah, Adobe is super hard to unsubscribe from. And yeah, well, it's not as easy as Netflix. I did it live. Like I just on the same stream, I was like, all right, we're going to see how hard it is. And it was just click, click, click. I feel like if you're not, very technologically challenged, it's not difficult. But if you're not technology yet, it's easy. But if you are, it can be very difficult. And I'm speaking only for the consumer product, not the enterprise product. That could be a different story. That could be complex. Okay. So, but yeah, so Netflix, what I see is like, in terms of unit economics, what's wonderful about them that is not really shared is and this was the pitch I did back in 2022. It's the same pitch. It never changes. That's the beautiful part about these phenomenal businesses. If the same idea, the same reason to buy it in the past 5 years could be the exact same reason to buy it today, which is the case. Netflix did not have, as we recall on the video I did back in 2022, it did not have subscriber decline if you account for the Russia exclusion, because the only reason why they printed subscription declines was because they voluntarily removed themselves from Russia. If you adjusted for that, they never had subscription declines. Fast forward to today. What do we have? An immensely robust advertisement platform that's growing in utilization. What they have to work on for Netflix is actually making sure that their utilization is high. What do I mean by that? So like the placement of ads needs to be a little bit better. There are slots that are empty, and they got to work on that. They talked about that during the call. So if you're following Netflix, you kind of just want to watch how the ads platform improves over time. And that improvement is going to lead to increased monetization. And again, going back to like the original reason why you might like Netflix is because the product or the unit economics are so favorable that when you get a new subscriber and you've already paid for the content, that new subscriber goes straight to your bottom line. That's pure profit. That doesn't change. And so that's the part that's super attractive about the business. And if you increase the average revenue per user, you think of new ways of monetizing. You increase the price, you introduce advertisers, so you get a whole new cohort. And then the advertisement, remember, so in ads tiers, you care about utilization. So Netflix has introduced themselves to a utilization metric that YouTube is more famous for. So YouTube, if you're not subscribed to YouTube Premium, then YouTube cares a lot about the utilization of the product. And what I mean by that, well, if you're just purely ads, it matters to me how often you visit. Well, technically, it always matters to me how often you visit, because if you are subscribed and you visit a lot, the likelihood you unsubscribe from the subscription is very low. But if your utilization is low enough, and every person has a different level, that's the difficult part, but there's maybe averages. If your utilization level is low, but you still don't unsubscribe and you just keep paying Netflix doesn't care. I was like, great. I mean, you're paying us monthly, and let's say you watch it every once a week, twice a month, something like that, right? Doesn't really matter to them. They're getting the same money from you. When you introduce ads, now you have to make sure the utilization is high, because that's how I serve you ads. Every time you watch the video, I get to serve you an ad. If you're not showing up every day, then I can't serve you ads. So I need to make you show up every day. And so that's why Netflix has put themselves a little bit in a situation where they have to introduce a reason for you to show up more often. And that gets into like, yeah, you want to like maybe perhaps covet more IP. Warner Bros. Discovery comes to mind. But in the case of YouTube, right, or Instagram, they've always been that way. In fact, Instagram very much so wants you to visit more often, because they're just serving you ads. There's no subscription to Instagram, so they need you there. And then YouTube, again, it's like that separate relationship where if you're subscribed to YouTube Premium, then technically if you showed up to YouTube like once a month, it wouldn't change. It wouldn't matter, because they're not serving you ads anymore. Okay, so moving on from that. To answer that question, update thoughts on day specific. Oh, we already answered that one. Can I ask if you? I don't know why I started that one. All right, so now we get to the question of C versus Melly. So we are not long C, but we are long Meli. So Mercado Libre is a bunch of companies wrapped into one, and their culture is phenomenal. One of the things that we love about Mercado Libre is they are a fintech platform that is building and introducing new fintech products all the time. They have a payment point of sale system. They have a buy now, pay later product. They have financial products for retirement. So they're doing a lot of things. One thing that's difficult for especially Western investors to appreciate is the underbanked. Oh, hold on. There's a question here. I just came back to the main chat. Remember, I'm coming back and forth between, there's two chats for me. There's my starred chat where I start all the questions, and then there's the main chat. So again, I don't mean to skip over questions by accident. So are you against the Warner Bros. Act? No, I'm actually for it. I think it's a positive. I think if any company could do it, it's Netflix. It's Netflix. What I hope for is they don't change too much from Warner Brothers' culture. There's obviously some tweaks that could be done, but like they don't meddle in it too much, because a lot of the benefit from Netflix is the decentralized approach. They're now going to take a much more centralized stance, and there's a give and a take there. So it's kind of like I'm generally for the idea, but I'm also like, okay, there's a lot of ways you can fuck this up, so let's not fuck this up. But I believe in them. I'm going to give them the shot, the benefit of the doubt that they're not going to squander the asset. All right, but back to this question on because that was pertinent to the prior. So Mercado Libre, I think what I love about them, again, we go through culture, we go through the actual space that they're in. They took the Amazon approach to customer service, and something, again, like what I was about to say, Western investors have a hard time understanding the gaps in value or the gaps in offerings in Latin America. So things that, you take for granted. I call it sometimes the Western normative mindset. So you attribute what is normal to you and you attribute to be normal elsewhere. And that assumption is in and of itself a mistake. It's a form of bias. And so one of those biases comes from, the belief that what you have as a banking environment, what you have as banking infrastructure is commonplace. It's not something you think about. You don't think about Brazil's banking climate too often. You don't think about Mexico's banking climate too often, or Colombia's or Argentina's or anyone. But if you are from there, you know this. You are aware of it. There is a higher distrust for banks there than in the United States. There is a much larger underbanked population there than the United States. And so those are things you can capitalize on. So if you, and this is something the founder of Mercado Libre, who did study in the United States for a bit, figured out when he returned, was there is a huge market in all of the continent for someone to offer a very reliable, very streamlined product offering for a lot of these services. And it's not just them. Nubank figured out this as well. So there's a lot of these similar entrepreneurs who are applying, sort of like westernized standards of certain business lines to Latin America, and they're receiving tremendous success. And it really comes down to it. I think that's what's hard for, again, investors here to appreciate what they're doing. But you see it in the numbers, so you appreciate that. You're like, yeah, there's a lot of growth here. But Mercado Libre, there's so much horizontal expansion opportunity, because they're also figuring it out from this perspective. They're saying, like, I'll ask you a rhetorical question. Why did Mercado Libre get into the fintech? Why? Remember, they build everything internally. I'll pause for like a few seconds to see if someone can answer that question. But like, I would love to know if everyone who's in the club, that you're cheating if you say the answer, because technically you should know. But anyone who's like not in the club, like a public viewer, why do you think Mercado Libre built their own fintech solution? The answer is really telling of their culture, and how they've done with everything else, right? And so it's like, well, I'll give it like 10 more seconds, because there's a bit of delay probably. In the meantime, enjoy this dance. No, okay. There is none. Okay. I'll wait 10 more seconds. Well, I want to be fair because someone might be typing longer. In the meantime, if you're enjoying the stream and you haven't liked already, feel free to like, share, subscribe. Heart it on Instagram. Heart it on X. Okay. Well, the answer to the question is like, why did they build the fintech stack? Why did they build anything? Is because when they're doing their business or mode of operations, they find that that's a friction point for their customers. So naturally, I'm an online banking platform, or sorry, online banking. I'm an online retail platform. I'm going to sell things to you. How am I going to sell things to you? Oh, great question. I'm going to sell it via the internet. Oh, okay, cool. I don't have a bank. I also don't have a credit card. And that's a lot of people. So Mercado Libre thinks about this. How do I expand my total addressable market? Because right now there's a lot of underbanked folks out there. Okay, well, we could wait for the banking system to develop. Like that's an option. Like we could just sit here and just think about things and look at each other in the eyes and just like wait 20 years and maybe the banking system develops further and resembles that of the United States. Or why don't we do it ourselves? Was the idea one of them had. And bada bing, bada boom, one thing led to another. You start building all these internal products yourselves. And so that kind of speaks to the culture of Mercado Libre. Everything along the way, when they build it internally, it's a problem. It's saying like, okay, we're having this friction point with our customers. Well, how do we fix the friction point? There doesn't seem to be an infrastructure that fixes this. Okay, the answer is, oh, just don't do it with them, with Mercado Libre. The answer is never, oh, we're just not going to do it. The answer is, oh, we'll build it ourselves. It's kind of like, to bring some pop culture into this, like Thanos, like, oh, fine, I'll do it myself. That is Mercado Libre with like everything. So if you if you find a friction point, if they find a friction point with them and their end customer, and there's just like, oh, if we built this, they will come. And it's not only that they will come, maybe others will also come and develop it further, and we can still have a very thriving ecosystem. Then great, fantastic. And Mercado Libre also noticed that there was a gap, for example, in things like creating a localized economy. So then the birth of their point of sale system was born. And then they connected the point of sale system and those merchants onto the online platform. So then you're starting to create this ecosystem around all these like hyper localized economies. So what I mean by that, here's an example. The pharmaceutical division of Mercado Libre, they didn't just like build their own pharmacy and then try to destroy all the local pharmacies, etc. Because why do you want to create that friction point when you have with all that wonderful distribution ready for you to work with you, and you can generate more so like a fee-based relationship? So the solution was simply, well, we'll take all of those pharmacists in Brazil, for example, and then we will cooperate with them. We will offer solutions. We'll offer our infrastructure to them. And then now that pharmacist can service a wider geography of people. So people who didn't have access or didn't know or didn't, couldn't get to that pharmacist or whatever, they now have access to that pharmacist. And so they're building their own infrastructure all the way through. And that's the culture at Mercado Libre. But also that's given by the opportunity set in Latin America because it lacked those things to begin with. And so just taking that approach that like Amazon here, well, they had a similar experience, and that was the birth of AWS. It was the same thing with them. So Jeff Bezos couldn't find a solution for this problem he had. So what did he say? Did he say, oh, I'm just not going to, do Amazon? No, he's like, oh, okay, this is a problem and I need to fix it because it's a problem for me and there's no solution right now for it. So I'll build it myself. And boom, there was the birth of Amazon Web Services. Mercado Libre is that, but with, the fintech stack. Because for them, the cloud already existed. That wasn't a friction point. They didn't need to build their own cloud. They needed to build their own distribution infrastructure. They needed to build their own, payment infrastructure because that wasn't present. And then they became extremely dominant, and this whole massive flywheel was born. So, that's my bad $200. What's going on with Food Hat? Oh, he's playing Magic. Okay, and to answer the question, SE versus Meli, I prefer Mercado Libre for all those reasons I just stated. It's not to say SE is bad, and actually SE has done a lot of changes that I liked. So I had complaints. You asked me this a year ago that SE was not, doing a lot of the vertical upgrades or the vertical build out of their infrastructure. That's since changed, and I think both SE and Mercado Libre should do well. I just give the slight edge to Mercado Libre for the time being. But I don't hate SE. I know that's not the exact answer you wanted, but technically the answer to your question is prefer Mercado Libre. But it's not because I dislike SE anymore. I used to not like them, but they changed the reason why I don't like them. Okay, so Duolingo. This one is wow, yeah. Like this one's, I don't know, talked about a lot. Oh shit. Wow. Mentally, the stock was still like $400 for me. I haven't looked. But Duolingo, I kind of chuck it along as in a similar boat or vein as like anything that's much more easily replaced by AI than not. And it's not the AI directly, okay? Because I think that's something that is misrepresented or people get wrong. The AI threat to Duolingo comes mainly from the actual competing products that can now be built against Duolingo. So with any product case, it comes down to a lot of the friction of switching, the friction of transitioning, or the friction of choice, right? So Duolingo already has the one problem that if you talk to all the people who love to learn languages, that Duolingo is not the best one. It's actually for the people who want to, as they say, as most people I've gone to learn, feel like they're learning a language or feel like they're doing something. So you are essentially compensating Duolingo for providing you the dopamine hit that you feel that you're making progress on something that you might not be making the same progress you think you're getting. Now, where AI comes in is not the actual LLM per se that you're interacting with that's then, replacing the service of Duolingo. While in theory, if you're a very scrappy person, you could do it. But it's what the products that could be built on top of AI using, various API keys, et cetera. And then building that product, then you can have these competing products much more readily available to compete against Duolingo, which just increases the uncertainty around the business. So by that same token, I would expect to see deceleration in revenue growth. I haven't looked at the revenue growth rates, but that's what I presume. If I were to look for, that's where I would start. If I would start to see deceleration in revenue growth in a meaningful way, then that would raise a red flag there. And then another thing for Duolingo, and to harp on this point more, is again that friction. So does Duolingo have anything that makes me want to stay on Duolingo or utilize Duolingo over others? If the answer is no, then yeah, it becomes problematic thesis for me to defend because I view AI constructively as like it's not directly a threat, but it's going to enable a lot of new products to be produced. And who entrepreneurs and developers are going to target is first the ones that have lower friction costs of switching. So that's a lot of consumer products. Consumer software can be very competitive. And so, while Apple sits at the top of the stack, or technically at the bottom of the stack, and everything's built on top of it, they are not at threat. They have this moat that's incredible, et cetera, blah, blah, blah. And they're more a consumer technology product. Duolingo is an application that's built inside of it, so it's on top of it. and it's going to be competing for space amongst everything else. Is it a difficult product to replicate? Probably not. So it's like what I'm trying to distinguish here is the difference between this and like VMS. It is not of a critical nature. It is not where of something that you have, poured entire swaths of memory with, because like someone might bring up a question that's valid. It's like, okay, hold on, but what about LLMs, right? These are consumer facing. No. So, well, they are consumer facing, but no, they're not the same, because an LLM is actually developing a memory stack with you. So it's getting to know you in a very deep level. It's like when you look at OpenAI, which by the way, it should like horrify all of you that you're not like, not horrified, put you in awe. OpenAI has that many users, what it has, and it's still grinded. So Gemini surpassed OpenAI in terms of downloads for just a few months. And then OpenAI got back. OpenAI is the largest one. The fact that it did that is crazy. And some of the folks that, kind of were giving some context to, the discussions around Gemini in Japan versus OpenAI. OpenAI's penetration in Japan is like horrifying. Okay. So that's like the most extreme example where if it doesn't slow down, it's like you're just printing people out of nowhere. Like where are humans coming from? So the penetration in Japan is like ridiculous. Like I said, when you have 900 million weekly active users, and where the intent trigger is on a visit, on like an opening of the application, on going to the website and searching OpenAI to talk with ChatGPT, or opening the application. So that intent is there versus potential accidental usages, like, oh, it's in my email, or oh, it's in this or in that. It's all integrated. And so there's a lot of ways I can trigger it. When you say the weekly measured as such, it's a big difference. And that is very sticky. Already, like the same thing that protected the same moat around Alphabet for the past decade is also fairly true for OpenAI. Because going back, my college days, even before then, there's always been the existence of the better browser. The better browser has always existed from Google. Yes, Google is full of ads, but it was part of my behavior set. And if you're not part of in marketing, you have the different types of consumers. You have the innovators that they focus on, like the hottest thing, the bleeding edge. Then you have like most normal people. Most normal people, they use something, they're used to it, they have their consumer behavior around it, and they never switch. In order for them to switch, the product, I think Peter Thiel put this into sort of like a hyperbolic example of it has to be 10x better. There's no science on how much better something has to be, but it captures the idea of what I share with the club members on, like, just general business principles. If you want to supplant what is already implanted in people's minds, you have to be so much better that it's almost detrimental to use the opposite. So in the case of like Duolingo, as an example, going back to them, this example is very pertinent. If it's sort of known that Duolingo is not a good way of learning a language, and your goal is to learn a language, and then there's another product that's offered that is, and you have access to the internet, you have access to LLMs now, who can recommend, and this is all going back to monetization, advertisements, etc. You can have let's say a product, and to my knowledge, they do exist, where it is detrimental to use Duolingo versus the alternative, versus the other products that may not even exist yet. So that's just an example to say, like, that's what you have to offer the consumer. You cannot offer marginal improvement and then expect massive consumer change, because that's what protected Alphabet. Like I said, there are better browsers. There are, or have been, better browsers. There have been better search engines that are not, well, maybe they were only better because they didn't have the ads. That's someone might argue. But those have existed. Alphabet's still here. Alphabet's still number one. Alphabet still controls all the market share because the consumer behavior was already set in. And you cannot, that's why technically LLMs were the first thing in forever that could have disrupted that behavior set. And that was the concern. Because, and this is like, at least with my work set, so my sort of everyday experience, I've actually gotten to the point I cannot go back to traditional search forms, but everyone's different. Everyone's different. So for me, that for every consumer may have like a different level, and it's all about, you know, appealing to the mass consumer. For my workloads, I do not feel like, you know, going back to search, the old way of search is in my cards. I can't do it. It's too archaic now at this point. The productivity is so much less. The efficiency is so much less. The speed at which I find answers, sources, everything way slower. So I can't go back. To me, it's a detriment. But to someone who doesn't maybe, you know, use it for anything serious, it could be whatever. Could be like a noticeable change. It's like, haha, ChatGPT, like what is the what's the weather tomorrow? Oh, tell me a joke. Yeah, okay. If you're that person, you know, it doesn't matter. But yeah, hopefully that answers your question on Duolingo. Okay, so that being said, I got through all the questions. You see, no one can say I don't go through all the questions. I'll sit here and go through every single question that you have. Oh, never mind. Lies. I skipped this question by accident. Any thoughts on Qualcomm? We don't have a short position on Qualcomm. We're not very bullish on Qualcomm either. We're just neutral on it. It does feel like Qualcomm is fumbling the bag because they are. I think at one point, you know, I know at one point Andrew did have a short on Qualcomm, but presently we do not. All right. Can you have a look at Otis? Oh, I already looked at Constellation Software. If you go to the timestamp of, you know, software, it's in there. Otis I haven't looked at in this video, but I generally like Otis. But the explanation I can explain to you on the business model is Otis has, you know, the revenue per se is just like a way to grow their install base, and their install base leads to the true gem of the business, which is the service revenue. So it's really similar to another business that we are long, which is GE Vernova. So sorry, GE Vernova, which is ticker symbol GEV. It's a very similar premise to that. Oh yes, by the way, we are hitting 4 hours. So if you did not like this video, I swear I'm banning you. I'm kidding. I can't ban you guys, but yeah. And there's 360 people watching. So welcome to all 360 people. And wherever platform you're watching, you know, interact with it, and that's how you say thank you. But yeah, going back to Otis real quick. So with Otis, the business model relies heavily on this idea of growing the install base, and then subsequently, you know, following that, that install base, you service it with service revenue, right? And that service revenue, that's the gem of the company. So GEV, General Electric Vernova, which disclosure, we're long in the fund. That one, really similar argument. And not to take away light from Otis, because you asked me about Otis. So I'll spend some time on Otis, but then I'm going to talk about GE Vernova because I feel like it. So in the elevator business, you have you know, a fairly mature market. There's not a lot of growth here. And that's maybe the only drawback. So if you're looking at this more so from a stable business, sure, fine. But if you want really great returns, I think you have to wait for a lower price. Because again, this is not a growing industry. This is a very mature industry with its set of players that sort of dot the map of the United States, the world, etc. And you know, they are what they are. They have the control that they do. And you know, that's not going to change anytime soon. There's no massive outlandish build out of new cities and skyscrapers that they can suddenly benefit from. But that being said, the growth rate not growing too much is not really the end of the world here, because like I was saying, the actual sales of equipment, of units, is, you can think of it as that is the embedded in that is the implied growth rate or growth for the servicing business. So then coming back to GE Vernova, we sometimes make these companies look more expensive than they might be. But coming back to GE Vernova, which is a growing business and is very similar in the same notion or same vein as Otis, you have a business with a very, very difficult, I don't want to say impossible, but very difficult, very complex engineering product to replicate in turbines. Turbines are utilized for energy. And it's had a fantastic run, probably will continue to have a decent run. Among them and Siemens, also Hitachi Power. So GE Vernova has a few segments. They have the turbines, they have the gas turbines, wind turbines, and nuclear. So the nuclear business is a joint venture with the Japanese, and that one is a 5-year story. That one is going to be a lot more pertinent as we get closer to 2030, when a lot of the nuclear reactors start to actually progress and come online. So that story will be a longer tailwind into the future. The wind turbine business is the big question mark, the unprofitable, the ugly duckling that causes their margins to look worse than what they will be in the future. A lot of those products need to be readjusted, renegotiated, and we're going to see that eventually. We'll actually start to see that next year. So in 2027, GE Vernova will have a lot of those contracts renegotiated. In fact, if I go into the share price, let me zoom in on the past 6 months. The spike from here to here, this gap up we saw, that was from the announcement that one of the contracts was renegotiated. It was a contract with Taiwan. And on the surface, you look at that and say, why did the stock price go up that much? That makes no sense. Well, because, and at the time we pitched it to club members explaining that, and not here, we explained that when we initially pitched it, which was, if this business is turning around, we don't have really a semblance for what these contracts are going to look like when they start to, turn over. But that Taiwan contract was a sort of glimpse into what the contract renegotiations will look like. And so wind turbines are going to go from a drag on earnings to actually being a tailwind. When we see that tailwind, then, you start to get to the valuation starting to compress a bit, or it starts to grow a lot more into its valuation there. But also with the gas turbine business, that thing is still growing like crazy. Really, the only bottleneck there is their production capacity. How much can they produce? Because the industry can't get enough of it. And so we've spoken to folks who work at, NextEra Energy, and, they've been there for 20 plus years. They're explaining to us, yeah, we need more turbines, but they're booked through 2030. And GE Vernova just has to increase production capacity. And then they can also subsequently increase prices. Like, there's a lot of, different tailwinds happening all at once. So yes, and subsequently the unit sales include or increase the servicing pricing later down the road. There's a lot of businesses that have that. ASML is similar, Applied Materials, KLA, all of those guys. Like, anything that has complex engineering products provides that benefit as well. I look at sales and DLO. And that said, they are software. Oh, did I misread your question? You were asking about you weren't asking about Duolingo, were you? I'm gonna laugh my ass off. Did you ask me about oh my gosh, you asked about the local. So that's, you see, that happens when you go for like 4 hours. So I read your comment from before, unless I'm going crazy. Did you ask me about Duolingo? Or did you ask me about DLO? Because I went on a whole rant about Duolingo, and you might have been asked me. You might have asked me about DLocal. That would be hilarious. Okay, but DLocal as a business, I mean, yeah, it should be fine. There's a lot of there's a lot of opportunity to go around here. Same with Pago Seguro. Like they're solving important solutions. They IPO'd at crazy multiples. And in the case of Pago Seguro, like a lot of people get excited about these like solutions in the third and second world. And yes, it's exciting. Yes, there's a lot of growth because generally they also have fast growing economies, depending on which one we're talking about. And the opportunity set is huge in front of them. So my only problem with dLocal and Pago Seguro is like governance, if anything. And I tend to focus like, because Mercado Libre, I can say more confidently, has a really high quality management team. I can trust them, in my view. I could be wrong one day and they could break my trust, but for the time being, I can trust them. I can trust the culture that they've built there, and I know that they got the ingredients there to win. I haven't done enough research to say that about dLocal or Seguro Pago. I do know that their opportunity set is robust, and there's a lot they could grow into, and that's all I can really say. The same thing I'd imagine, dLocal, like when you see what they IPO'd at, it's the same story. Lots of excitement, lots of impliedness in the price. And now, it got down to a point where relative to the earnings projections and the growth rate, it makes more sense. But no, a lot of fintechs, Dave IPO'd at the crazy price. Like, let me show you Dave if you haven't seen this. Like I said, we're long Dave. Look at this IPO. I mean, it's SPAC. They went through the SPAC craze. It's still like half its IPO price. It's trading, split adjusted like $5 right now. So if you had the warrants, like you're crying right now. Like the warrants are probably worthless. Yeah, Pags and Duolio are to me are like credit cards in a way, or prepaid on Pags. Yeah, there's a lot. Would I DCA into Visa at this price, or thoughts on DCA Visa at this price? Okay, so Visa, I went over their earnings report, and also MasterCards. Like, you're not going to get a lot of sudden growth in Visa. It's not going to happen. You're going to get really stable, robust earnings growth for the foreseeable future. There is no real credible threat to Visa's moat that I see with the information we have today. There was a threat, stable coins and the like. And at the time I said we should take it seriously. We should investigate whether or not the threat of stable coins is real. Like, we shouldn't say, oh yeah, dismiss it immediately. And the reaction to it, after reflection and analysis, was not justified. Was the valuation justified? Because that was back here. I remember because I was on vacation when it happened. This gap down was the fear of stable coins. Well, now you're even lower priced than that. The stablecoin threat, stablecoins are solving a solution that doesn't need to really be solved. And that's the reality of it. And stablecoin businesses are awful, by the way. They're not very good. They're very tied. Their destiny is not even tied to them. So for example, a company like Circle, we view it as like you're basically playing short-term interest rates, but with volatility. So it's like, well, I guess there's a place for that. So if you think short-term interest rates are going to rise in the future, that will be a very interesting business to play. So as long as Circle doesn't go bankrupt and we enter an environment in the future where we're at lower interest rates and you think interest rates are going to go up, put that on your watch list. And that could be an interesting investment because you'll get a spike in earnings, because that's all really where their earnings come from. And there's a few other businesses I like a little bit better that might also fit that category. HCM businesses, etc. Yes, I'm still live and we're going on 4 hours. I mean, I haven't been live in over a month, so I'm kind of making up for it now. And I keep getting questions. If I keep getting questions, I just keep going, Julius. I can't help it. I suffer from a severe form of autism. plagues me. So again, it's hour 4. So every hour I say one joke. That's the way we're doing this. So I've already said 4 jokes in this stream. I don't think there'll be a 5th. I don't think I'll go for 5 hours. So yeah, I wouldn't be really opposed to the idea of it. Good night to CM Goats. I'm old like Dan, need my beauty sleep. You went super saiyan tonight. 5. Oh, thank you. Thank you. The impact on AI, Snow, CRM, justified. So, okay, we'll go down by down. So, Snow never understood the valuation. Any narrative, this was my view before. Any narrative chink in that story was just like gonna cause problems. So that's all I'll say with them. ServiceNow, the product, no. The valuation for all software. So not to go into it too deeply, but I went on a whole rant on like how, in our view, like software companies, they started off from the wrong footing, and it essentially. And when I say wrong footing, it's really about valuation. Essentially, they've always wanted you to look at adjusted figures, because if you looked at the GAAP figures, they never were very attractive from a valuation standpoint, and that never mattered until now. Now it does matter. So that's always a beautiful thing about the markets. Nothing matters until it does, and then you can go years of saying this matters, this matters, this matters, this matters. It never does until suddenly, boom, it does. And everything that's all relative too, because if they're growing fast enough, and they're trading at even like a gap of 100, but they're growing at like 50% CAGR, that doesn't matter. They'll grow into that valuation. So you can excuse it. And yeah, they look better on an adjusted figure, but you do the adjustments, and those adjustments, you're like, the growth rate still makes sense. But now you're entering this phase where it's like, Salesforce is not growing that much anymore, and it's trading at 30 times. Is that justified? And technically, like I went on again, there's also other rants about, there could be efficiency gains that are met by firing certain employees, and that this could be true for all of them. I view software as like having that potential, right, of achieving that, but the as far as like how to go about it, it's maybe easier said than done, because I don't work in Adobe. I don't work at Salesforce. I don't have that ingrained high level view. But from an outsider looking in, I think that there's probably a lot of bloat at the industry, and I'm not talking about engineers, because I just want to reiterate that to all the engineers listening, because I have a lot of engineers who are part of Capital Mindset, and it's like, no, I'm not talking about you. Don't worry. I'm not talking about you. I'm talking about, around there's probably some fat around the edges, maybe some in engineering, but for the most part, maybe you need more engineers, and maybe less of other things. Perhaps that is something we observe, and then the valuations start to collapse in a good way, as in like the multiples compress because earnings go up a lot more, and we see reacceleration. That is possible. In fact, I'll give an example of a company that's more of an HCM, but Workday, which has also collapsed. It doesn't even matter. On a GAAP basis, they're growing a lot. Actually, ServiceNow, I think on a GAAP basis too, they're at a peg of 1. So I think ServiceNow and Workday are examples of this, where they're both focusing on true profitability now, because it matters. And then the management team has woken up to that. They're saying, oh yeah, like the market actually cares about how much we have in earnings. And so we need to focus on this whole profitability thing. And so that's been in a lot of the initiatives behind Workday, behind ServiceNow. Workday in particular, I think, has still the backing of Elliott Asset Management, who's been kind of helping them in the consultory phase of figuring out, okay, what it is that we have to, do and get behind to make this happen. And yeah, just like kind of an honorary shout out. I know no one asked about them, but yeah, Workday, all the theory sticks out. Sticky product, maybe not really disrupted by AI per se. ServiceNow as well, same applicable. And more a question of like how they integrate artificial intelligence into their product suite, not really how they die from it. So Here when we wake up. Okay, so not this. I'll answer this question, but this is not to be like a full-on advertisement or anything like that. But the stated objective of the fund is we're trying to work within our core competencies that we have, and we're basically like, for example, one of our partners, he's almost like literally an expert in financial technology. So we look at where we have our deeper understandings, and we're trying to exploit where the market is pricing, like the same old marketing jargon that you'd see at any firm. And the whole like, we're not saying obviously, oh, on a risk adjusted basis. We actually have curtailed our investor base to be more so total return focused investors, because we're not looking to manage a pension or anything like that and say like, oh, on a risk adjusted basis, our returns are X. No, our stated goal is not undue risk, and we don't view volatility as a measure of risk. But total return is the stated goal, maximizing total return and minimizing permanent loss of capital. Because some funds will state, their goal is to, achieve some sort of level of volatility, et cetera, blah, blah, blah. That's not our goal. But this is not, meant to be an advertisement for that. And for full disclosure, what I just said is, just like a personal opinion, personal statement of mine. It's not an official opinion of Fraxinus, I should say. And should highlight, now that I said that, please read in the description below. There's a link to a set of disclosures that should be available to you and should be read, on any comments being my own and not pertaining at all to the other partners and their opinions. It's strictly my own. Okay. Have your morning cappuccino on me from... Yeah, I don't have one of those near me, but that's an expensive cappuccino. Thank you, Hugo. Much appreciated. Been a long time since the last poverty stream, for real. Yeah, it's been a month. So I'll answer the final questions, and then I'll start to also provide the update. But I do want to really start, hammering out some more content. Because again, like, this is fun for me. This is like the passion project, Capital Mindset, talking to people. It's what started it all. I mean, like, without Capital Mindset, the fund, never would have gotten started. So it's still appreciating the roots of where, everything came from. And what started as like, oh, I want to put out content, put out things out there and share my thoughts, became Capital Mindset Investing Club, and then became the fund. And so never forgetting the origins of things is important. So that's kind of like the, real short spiel of like the goal. I want to start putting out more content, either like more weekly live streams, not a monthly one, or even daily. Because honestly, there could be an easy commit once a day, a soft commit. I should say it can be a soft commit of once a day, because there are very likely events I can foresee where, world events happen, and I got to be on call basically with Andrew, Michael, the partners, and we just have to go over some things. And that might be like, oh, I can't do 4 o'clock every day, for example, because I can't promise that, or I can't do really during market trading hours. Becomes a bit problematic. Maybe I'll have to think on it. And then videos, I do want to get video content out, but a lot of the ways I did video content was through requests. And so I'm thinking about how to reintroduce the request, because that's how I like to drive things. I don't like to, I don't like using the YouTube recommendation crap to tell me like what content will do really well. I prefer organic requests. And in that way, I think it's like cool for you guys, because you guys like, oh, I have a question on this. And if you looked at my old content, there was no obscure, I would be careful of like, looking at, is that a pump and dump? If you're a bot, I'm not going to answer your question, obviously, but there are companies out there that do not get a lot of views on YouTube. You ask it, I won't not do it because it doesn't get a lot of views. I will do really obscure companies and, talk about it for 40 minutes. 30 minutes. Doesn't matter to me. But I want to reintroduce that flow of content. But it has to come from I need like requests given to me. And so requests come in, and actually I'll broach this topic to the Capital Mindset Club members, and get requests from them too. Get requests from whoever. At one point, maybe I'll be overwhelmed again with how many requests will come in. But right now, I need to get started on some requests. If people want me to talk about Adobe, I'll talk about Adobe. If people want me to talk about Affirm, I'll talk about Affirm. Dave, I'll talk about Dave. I'll talk about Meta, I'll talk about Meta. And then organically too, there's going to be videos I just want to discuss as well. For example, don't forget, I did see your question on United Health. My brain's remembering you. But the question on United Health and all the healthcare companies, and we'll answer this one first. Given the choice, would you choose VGT or VU? I'm usually, if I'm doing a index approach, I like to just go, and recommend the standard index. Like VU or VTI, like a total market or a S&P 500 is perfectly fine. When you start to get all like, starting, favor a factor, et cetera, you're no longer passive. You're really no longer a passive investor. You're starting to factor select and do all these things. And if you're trying to be active, you're trying to be active. If you're trying to be passive, you're trying to be passive. So figure out that first. Like, is this money for passive or is this money for active? If it's active, VGT is like an active, it is active. Because I believe, if my memory serves me correct, that's the technology ETF, right? The Vanguard technology ETF or information technology. Yeah. So this is an active approach. So you're making a bet that information technology will do better. And if you're an active investor, yeah. Oh, and to answer your question directly on like what I would choose, I would probably, yes, do VGT because I'm an active investor. I'm not a passive investor. While I preach passive investing, I do not partake in passive investing because I'm a hypocrite. No, I'm kidding. But no, in a more real note, like for the average person that does not, have the time and does not enjoy it, because there's also an enjoyment factor. And I'll say it this way, because I've done a video on this, and like this is more so if you're talking to someone in your own life. One thing that if you want to actually help them with investing is you got to figure out how they think about things. So for example, I think it's like, I told this to Strong Man because he hates on dividend investors a lot. And I get it because they're freaking annoying sometimes. Like they're just like, oh, dividend investing, only dividend investing. Yes, dividend investing is not optimal. It's not optimal. That's the truth. And I think a lot of dividend investors, when you realize this, just come to terms with it. But there's nothing wrong with it per se. You got to figure out, whoever you're talking to, it's a family member, yourself, how is it you get excited about investing? Because the number one factor of your retirement is savings rate. Then the secondary important factor is returns. So those are the two factors, savings rate and returns. So if the first one is the most important one, well, what do we want to maximize? We want to maximize the savings rate. Well, if you are telling someone and you kind of figure out their psyche that they're not really, I'm not saying, by the way, oh yeah, their psyche is they're a gambler, so I'm going to encourage them to gamble. No, but like have the nuance to understand what is a more toxic form of investing or deployment of capital, and what is a more, okay form of capital. Like if they're into bonds, if that's their thing, then maybe that's okay if their savings rate's high enough and they get excited about bonds and they love bonds, or they love preferred stocks. They love the concept of the, income factory kind of thing. But there's a toxic side to that. But like, let's say it's the, more nuanced one. Okay. Have the nuance to understand what is toxic and what is not. Let me just start with that. Because then someone says, oh yeah, like I spoke to someone and they only get excited when they gamble. So I told them, in order to get their savings rate higher, put everything in Kalshi. That's not what I'm saying. Okay. So now that we have that out of the way, on an honest discussion on this, like you talk to the person, it's like, oh, this is a person that gets really excited for whatever reason when you talk about dividends, right? I know it's not optimal, but if I told them to buy an ETF, then they're just not going to save because they don't get excited about it. Not everyone's built that way. Some people are, and some people are, and they want to be passive, and that's great. And that's how you do it. Boom, done, easy. Some people are, their brain thinks in a certain way. And so if you want to actually help them, you got to adapt the help to the person. And some people, that's how they think, and you got to work with that. And some people, they prefer, or they can handle volatility. Some people can't handle volatility. So there's multiple ways to, cook a chicken, all right, to crack some eggs, and you just got to work with them. There's some bad ways to crack an egg or cook a chicken objectively, but like investing, you just got to change it up to their style. So that's a long-winded rant on a question that was just about VU and EGT. But anyways, so yeah, I really would like to do more of these. The question on this is the last question, so I'm closing off on questions. We'll talk about United Health and Elevance earnings, or all healthcare earnings, and we'll have Molina here shortly. So Elevance was hilarious. Like these earnings were actually bonkers, right? So initial reaction was extremely bearish. This thing cracked all the way down to under $200. $300 a share, and then very quickly ended the day positive 6%, something like that. So who would have thought, from down negative 6% to positive 6%. And then United Health on their earnings was down 20%, but not to be mistaken, they were down the night before because of an announcement that the rates for reimbursement was going to be lower than what people expected. All of them fell, and United has a decently sized business in the Medicare Advantage business. Elevance also has exposure, but less so, and then Molina has. It's mainly the Medicaid business. So all of these, the story has been pretty much the same from the get-go. It's really all about portfolio management, how they adjust their portfolio. And what I mean by that portfolio is like policies, people who are on the products per se. And when we look at what happened with United's plagued by mispricing over a longer period of time. This has been going on for 5 years or so, where medical costs have risen at, I believe the figures are like 6-7%, and policy rates have only increased on average like 4 to 5%. So that doesn't sound like much, but when you have a delta of 2 to 3% per year, and you have that for 5 years, it actually adds up. And the reason for the lack of match in pricing is a lot of the insurances made a mistake where they didn't aggregate the effect that utilization was having on the cost of healthcare, on the cost of distribution of said healthcare. So fast forward to 2025, all of it comes up to be a problem. We get utilization rates back to normal, and suddenly you have massive decrease in profits through increase in medical loss ratios, reflected by people using the services more. And then it got even worse in Q4 with a lot of the estimates that some of the companies gave, except for United, where the medical loss ratios were higher than expected. A lot of this came about because the fear, the sentiment does in fact drive behavior. The fear of ACA changes increased the utilization in the back half of 2025. So the prior predictions that they had for medical loss ratios were incorrect. And this pertains to Elevance, that they expected a certain figure, and they didn't really quite hit that. And that's part of what affected it. But for the most part, 2026 is guided to be the bottom level of earnings. 2027 is going to be a year for growth, and that's more or less what every single one of them has stated since 2025. So we might see the price recoveries actually this year become more sticky. So Elevance really hasn't gone down that much. United being back down under 300 is actually the more exciting one in some ways. Elevance is cheaper, and then the cheapest of them all, of the ones I mentioned so far, is Molina. And Molina, they're again more focused on Medicaid, and they're more of a buyback story than the others. Elevance and United are more comparable because they're heavily diversified. And then you also have Cigna, which is kind of doing its own thing with more commercial plans and no exposure to the government plans. So some people might prefer that approach or that take. But yeah, that sums up the things going on with healthcare. We'll have Molina report shortly, and then we'll get more information from them. What I'm excited to see what Molina says now about their guide, because they kind of missed the last guide, and that's what actually caused them to sell off close to 130 before finally recovering. And I'm aware that is Michael Burry's one of his favorite pitches recently. And I am in favor also. I also disclosure long Molina. Yeah. I should disclose long United. So no, the accounting problems that they're being accused of is sort of, that's the starting to get in like the nothing burger that shows up. I don't think there's the accounting problems people are citing, and also the investigations for fraud or allegations like that. There's audits they have to pass that are pretty strict, and would have been. And this is one of the analysts cited. It's like kind of like questionable, that narrative. And another thing about the the accounting practice that the one analyst I know you're referring to cited, that same analyst has a, first of all, very bad track record with price targets with United. They had a crazy price target when it was at its high, and they only got bearish when it was at its low. And then simultaneously, one of the things they cited being like a strange thing that was not really disclosed was disclosed. That's what we found interesting when we heard that. A lot of the club members pointed that out, that it was disclosed in the 10K. It wasn't disclosed, and that was like a verbal mistake or some kind during the interview with Steve Eisman, but that's neither here or there. Yes, we already discussed Micron in the memory section. Okay, with that being said, it's been 4 hours and 30 minutes. I think it's time for me to depart. If you guys enjoyed this live stream, feel free to like, share, subscribe, do all the things. If you're on X, there's 370 people on wherever platform you're on. But if you're on X, feel free to put a heart on it, reply to it, whatever you want to do. And then if you're on Instagram, do all the same things there. And I'll leave you guys and see you guys on the next one.